Welcome to Trade Live with IG. It's Angeline Ong, and we have a special guest with us today, Chris Beecham in the hot seat. Because Rich McDonald is on the road with Tom Sosnoff this week. And for those of you also coming on Thursday, I will see you there at the London event. But before we get to that, and we will see Rich later on as well, we have a packed show. So not just Chris with us, but we also have Axel Rudolph a little later on to talk about where the markets are heading. Looking like we're getting a bit of an early Santa rally here. But also we're going to get Rich, as I said, all the way from Edinburgh, dialing in. Then we have Issa Buttigieg himself to talk about trading psychology, and also joining me on market measures to talk about probability and how to stack that in your favor. And we end the show with Tom Roberts. So very, very packed there. Before we get to that, Chris, how was your weekend?
Yeah, not bad. Fairly quiet, I think.
Yeah.
Yours?
It was, I wish it was quiet, but I was singing. The family was performing.
Yeah, ditto. On duty.
Yes, on duty.
Remembrance Sunday, of course.
Yes.
Yes, very busy as ever.
We were quite relieved at around 11:30 yesterday. It was kind of like...
Do you always have that rush to go done for 11? Is that out there?
Yes, yes. But also because somehow during COVID and lockdowns, my daughter managed to secure the 9 to 9:30 a.m. on a Sunday violin lesson. Oh,
it's a good way to start the day, really.
Horrific. Which means they are pushing everyone out and then having to grab her at 9:30 to fling her back into a cassock. It's
a stressful morning.
It's full on Sunday. But otherwise, speaking of full on, markets are also full on, aren't they?
Yes, I can't believe you used the term Santa Rally. It is the 11th of November.
I know.
Forget. But it is Santa Rally already? Are you suggesting...
I think it's starting earlier. It's starting...
Are you suggesting that the president-elect is some kind of Father Christmas figure that has delivered the market?
To some
presents early.
To some people,
yeah,
I
that's
guess.
True. Certainly if you're a Tesla investor, your Christmas arrived early, didn't it, really?
No, did you see the 1 trillion mark?
Yes.
Oh.
And Nvidia passing 4, so it's now bigger again than stock markets in Canada, the UK, France and Germany and Italy. So it's bigger than most of the G8s or G7s stock markets.
Totally. We'll get to all that overnight action in a bit, but it is incredible, isn't it? What's happening out there with all these stocks, and it really was about not sort of looking at the rumor and sort of buying or selling the fact. So shall we get to overnight action on that note? Welcome back to Overnight Action, where we get you across all the stories overnight that might shake up this week. So, Chris, you were just talking about Tesla earlier on. Tesla, if you whack up my screen, hitting $1 trillion in terms of market cap. I mean, Elon Musk, that was said as the biggest gamble, and he was a true winner.
Well, we talk about risk reward, don't we? If you 50 million, wasn't it, spent backing Trump? 130 million, sorry, according to CNBC. And yet his return for over the past 5 days, 60 billion, is it something, I think?
Yeah.
In terms of shareholding. So there's a 10-to-1 risk reward for you, which would follow Axel's risk guidelines perfectly, I think. So delivered, I think, really. And now he's even got talk of an office in the administration, an office of government efficiency or something, I think it's.
Yes, the acronym is DOGE.
Of course, yeah. Of course it would be, yes.
Yes, it would be.
Well done, that one.
He keeps on talking about it and saying the acronym, you know.
Yeah. I wonder why. I wonder why he keeps using the acronym. But yes, cutting $2 trillion from the US federal budget.
Yeah, but he's going to do that via cutting red tape.
Yes. Right? But that's the thing that always gets thrust out, isn't it? Here in the US, let's cut red tape. It's always, we'll have red tape savings. Yeah. They never specify where they'll come from, but somehow they manage it. Yeah.
And somehow, you know, no one then talks about all the jobs that are lost in the midst of cutting the red tape as well.
Yeah.
Also, what's key about this whole Elon Musk thing is not just about that, but the fact that crypto and Bitcoin are only available to our premium clients, of course. but all that, you know, shot through the roof when Trump got in, because he's been saying for the longest time, I don't know what you think about this, that he wants America to be the epicenter of
the crypto revolution. Yeah, and of course it's built on the long history of innovation we have here in the US. It can reap those rewards, really. It's Trump pushing these kind of... Well, this is why the market reacts so enthusiastically to this, because it's an administration that wants to promote business as the way of pushing the US economy forward. Well, to be fair to Democrats, of course, I mean, they weren't exactly antithetical to crypto, but this is clearly a president who is backing this all the way. What Jerome Powell thinks of that, I think he was known to be tight-lipped about that on Wednesday, but that should be fairly interesting to watch as well.
What do you think this might mean for currency? I've got a trade on, you know, bullish on the dollar versus sterling. Also looking at potentially euro weakness now, given the strong dollar. What are you hearing from our clients?
Yeah, I think a lot of it desire to see this euro. Well, I think they're expecting it to go lower, essentially. We were certainly net short euro dollar right at the end of September. By now, I should think we have had some buying. Inevitably, people have been attracted by the fact you've had this huge drop in euro dollar down towards 107 over the past, what, 2 months it is, 2 and 6 weeks, not even that really, back down to these lows. Deutsche Bank last week saying they think the ECB could cut rates to what, 1.5, I think it was. Yeah, I think we've got more dollar strength ahead of us, really. People are very keen on seeing that greenback continuing to rise. And the logic is there, really, because if you think the administration's policies will be inflationary, if you think tariffs will push up prices, which is the one thing he didn't mention in the push for tariffs, but you can expect to see the dollar continuing to move. So 105 in the dollar index, more of that to come, I expect, really.
Gold, one that you hear me talk about a lot, trader friends, on the show. It's still on the decline. We saw it last week, you know, on the if you shorted it for the back end of the week, it would have been good for you. But gold prices still at the moment seeing some weakness there, falling a second straight session. Investors waiting, of course, on that CPI number, and also more comments from Fed officials this week for clarity on US interest rates. And of course, last week we talked about that funny JP.
Are you going anywhere? No. I'm staying exactly where I am, and they can't find me anyway. That's a great line, really.
Yeah,
Even if you wanted to, can't
someone took the time, Chris, to make a great meme, adding all the wolf on Wall Street.
Oh, I didn't see that.
You got to see it. So if you haven't seen it, you know, whether he goes, DiCaprio goes, I'm not going anywhere.
Fair enough. I think Powell knows. I mean, clearly his job is up in, what, 2 years? So he might well be going anyway. But for now, the man is sticking to his guns, really. But look at gold. It's one of those moments where there's an uptrend, and it's poetry in motion for markets, isn't it? Look at it. It just goes higher. Yes, it's come back off those record highs, but it was bound to at some point, and the stronger dollars provided that excuse. But they're certainly not changing the direction of travel there. If you were long gold from, say, from June, clearly you've done really well. Is it a reason to start fretting? Probably not yet, because you've had that higher high. It's not even a higher low yet, really. It's looking in that direction, really. But yes, it's had quite a bit of a knock. Just back to this blue line, this 50-day moving average. Maybe there's a bit more to go. We haven't really tested the 100-day since late July. So this is still an uptrend. There's no point in arguing with it, really. Yes, it's had a bit of a beating. Clients actually only 77% net long, which is quite low for gold. So that's an interesting one to watch, I think, see how that plays out in the next few days. But I'd still be watching this one as a possible turnaround story at some point.
Possible. I mean, I still got that line drawn there at just under 2,800. So, you know, on longer term, I'm still looking at that possibly before the end.
Maybe.
Well, maybe, yeah. Depending on what happens, maybe this will be a January thing when Trump unveils his policies. And don't know whether you've been covering. I try and read as much as I can possibly fit in, which is not very much. Some local news in the US, and there were quite a few builders of detention infrastructure, shall I say, that are quite happy with the results.
Yeah. I think it does feel like the market's in a wait and see mode because he's not in until January, although he's already got a head start by ringing up Mr. Putin in Moscow, which is interesting. Administration's policies will have to wait. We know that there's, on day one we want to do this, that and the other, but the rest of it, tariffs, what you'll do with China, this will take time to evolve. So I think you've got the initial euphoric reaction. What happens then is another question, really. And if you look at the first year of presidential election cycle, so from January onwards, you tend to get some weakness January, February, as the euphoria of getting the election out of the way eases off, and then maybe you start to see a bit more recovery. But I think the risk is that you get some volatility around this stuff as it starts to be announced, really, particularly in indices at those record highs, I think.
Mining, one sector that we watch quite a bit. Not sure whether this fell on Trader Friends' radar, but late on Friday there were concerns about this Resolute Mining CEO. Executives detained in Mali. Terry Holohan, a very big name in the mining industry, was detained by the military controlled government of Mali in West Africa. No one really knows why just yet. I haven't heard anywhere on the mining grapevine as to why it has happened, but it has caused some consternation if you trade mining stocks.
It's the risk, isn't it, with mine? And not to dismiss the situation, but clearly if you are a mining CEO and that you're operating in these countries where governance can be a question, it does bring this into clearer focus, if you like. Mali's clearly been in trouble. There was a coup in 2020, Russian involvement as well there, we think, as well. So it's a bit of a sticky situation, I think, to say the least, really. And of course, it will send chills through the rest of the sector because there'll be concerns about who else, where one goes, others could follow, and that's the major problem, I think, for the industry, particularly at the moment.
And this is I believe, the second time in just over a month when employees of a foreign mining company have been detained in Mali. Just getting you across as well on what's happened overnight in Asia. Japan's Nikkei, one that you look at with Axel quite a bit, ending slightly higher. Of course, the outlook there unfortunately weighed down slightly by dulled Sony's shine, rather. Sony itself soaring on the 73% jump in its quarterly profit. So that cheered investors, but overall it was not able to kind of really lift the Nikkei as much as thought.
No, but it's still clawing its way higher. I think Nikkei, because you had that huge volatility, and again, I'm using volatility in the correct sense of the word, which means stuff going down. Really, in July and August, this is what people talk about when you talk about volatility. They never talk about upside volatility. I think I said this on Friday.
Yes.
Sorry to repeat myself.
Downside.
The volatility is always just stuff going down, really, but slowly getting its way back to where it was. Took a bit of a knock since mid-October. But the weakening yen, the strengthening dollar yen as well, clawing its way back. Same sort of story, actually. It's a sort of flip side of the coin, really, looking at dollar yen. There we are, back again at 154. Partly because the BOJ really looking less keen on hiking rates again, and also because of that dollar strength around Trump election. So the two things, definitely the ones to watch. But Nikkei, hugely popular market with IG clients. So I wouldn't be surprised. I think the thing with August was that you had the baby thrown out with the bathwater, particularly because you had this volatility in dollar yen, and the Nikkei understandably took fright as well. And you had all these decent Japanese companies that are not expensive compared to the US, and they're making loads of money. Sony shows us this morning. But investors aren't discriminatory when they are desperate to get out of something. And you had this panic all the way down to 30,000, and then since then, steady recovery. And as the old cliche has it, markets take the stairs up, but the lift down.
And that definitely is true for many of the moves I've seen in recent years. But Chris, speaking of the lift down and stairs, S&P 500.
6,000.
Wow.
On Friday.
Right.
What a way to round off the week.
On a Friday. And I believe it was also late on a Friday, wasn't it? When it all kind of like kicked off, because I was so much excitement for me last week, especially after, you know, covering Thursday and Friday. But yeah. What time did it happen again?
Oh, well, this is the daily. If I go into the into the weeds of the 15-minute chart, we did really get through it. Yeah, Friday, just really towards the close, actually rocketing in right at the end, rounding off the week in absolutely amazing form there for the S&P. And euphoria, I think, is the way to describe the direction of markets this week. We went 300 points in the S&P, thousands of points on the Dow. Again, if we're playing guess the uptrend, this is one of the best out there. It's one of the best election years in history. And again, if you look at what we see after elections, you have some volatility around the result. And then once it's out the way, markets do tend to rally. I think 2016 is the obvious parallel here. And that was a relentless rise into year end. There'll be people looking at this, I'm sure, and thinking, oh, that's too overextended. It can't go up anymore. It's got to come back down again. But the risk is here, you're arguing with a market that's showing huge momentum, just incredible momentum on the basis, well, most importantly, of earnings.
And Axel and Rich and I were talking about this last week, and it's just the amount of momentum. And Axel likened it to like driving on the Autobahn, and everyone's driving on Autobahn. It's really difficult to slam on the brakes and stop suddenly.
Yeah, that's the risk, isn't it? That you get a sudden, something intervenes at some point. And people always ask, what's the next crisis? Or some people like to tell me what they think the next crisis will be that causes the market to go down. But the point is, I think it's always the ones that you don't see coming that will be the real source of volatility. If you can see something coming, if you see the election coming, you can price it in, you can start to work out the impact will be, and therefore you don't get the huge drops. It's when you have the thing like in July where the Bank of Japan suddenly goes from, well, 0 to 100 miles an hour in Bank of Japan policy terms for them, really, suddenly change policy and sound a lot more hawkish. That's when you get the surprises. At the moment, we don't have that on the radar, I think it's fair to say, and I suppose you can't see it coming. But yes, just don't argue with the market when it's in this kind of mood.
Even the Nasdaq crept higher. I mean, I'm just checking my Bollinger Band there because we were talking about this last week, and it has crept higher. And if anything, we're seeing that it has broken. I don't know whether it has held and closed outside the upper band because it looked like it did. This is the daily chart, people. It did a few sessions back, but not on Friday, but it's still in that upward momentum there. And this coming, interestingly enough, just showing you copper as well, because copper is flat at the moment, but we're just taking a look at high-grade copper now, if I may. I'm going to take off that Bollinger Band. Oh, there we are. But all this climbing of indices coming despite the fact that we had this disappointing stimulus from China, right?
Yeah, I think
that's also what I thought was interesting.
It was. I think the market was hoping for a lot more than some kind of dull debt announcement. I liked the line about we're going to hunt down hidden debt and get rid of it as well. And then how do you know you hid it? Well, that's because we hid it ourselves. I think it's we know where the debt is because we were hiding it merrily. And now we're not trying to hide it. But yes, unenthusiastic is the way to describe markets at the moment in relation to what China is doing. I think they were expecting new building announcements, high-speed rail, all this kind of thing that we used to from the China of old, stimulus programs. Debt programs, that's not exciting. No, that wasn't worth the huge surge you had in the Hang Seng, back down from 17,000 to 23,000 in that lightning space of time. And then since then, the hangover has been brutal. Really, for China. Yeah,
offshore yuan also weakened at that point, and also we saw that many of the Chinese car makers weakening. Not the other reasons for that too, because there's now real concern that the tariffs are going to slap these foreign EV makers, and guess who's going to get big contracts? Surprise, surprise.
Yes. Funny how these things work, isn't it, really?
But we live in interesting times. A fund manager friend of mine said, Angelina, at least you can say you live in interesting times. Rich and I talk a lot about debt.
Yes, it's one of his favourite topics.
It is one of his favourite topics, and he always talks about how he's concerned about, you know, the 10-year with Trump in place. Do you think it's now like?
Yeah, it's another. There's not going to be much fiscal rectitude, shall we say? Sorry to use a word like rectitude at 7:50 on a Monday morning, but it's the kind of. They're not going to really argue with spending money, and with a Congress that's clearly on his side. I think they're very much on the cusp of taking control of the House as well. So clean sweep, really. It's not an environment where people are going to say, no, you can't spend this money. Because Congress, this is why markets often prefer a divided government in the US to one that's got a clean sweep, because it means that you've got that break on the president. Now that break isn't there, unfortunately. So yes, I think Richard will be talking about debt and the worry about that for a long time. But as we said before, it's the kind of thing that doesn't really matter until there needs to be a catalyst. There needs to be something that really changes things. And at the moment, there just isn't. Everyone wants US debt. It's another currency. It's liquid. It's safe. Yes, the US government's a bit of a big spender, to say the least, but they always pay their debts, and there's no sign of that changing either. So that's why I think you've still got this enthusiasm for US debt. It's
been like Game of Thrones, isn't it? A Lannister always.
Yeah, exactly. And there's no sign of the gold running out at the end. So they are. What else do you need if you've got US government debt? And this is the thing. Okay, China has vast amounts of US government debt, and it's in theory can hold the US to account, but there's not much it can do. As I think it was Neil Ferguson said about 20 years ago, it's hard being the world's biggest creditor when your biggest debtor has 11 aircraft carriers.
Yeah.
What are you going to do? You can't apply pressure in that way.
You owe a bit of debt, you're a creditor, but if you owe a lot of debt, you're a partner.
Yes, exactly. The old story about if you owe the bank £1,000, you have a problem, and if you owe the bank £1 million, the bank has a problem.
I was really shocked, actually. This is kind of like, you know, some time ago now. Obviously, we had the great financial crisis. This was before, but in Asia, you would get that express lane to the professional lounge with the FTs and amazing premium coffee and all that. If you've been a customer that has been with the bank for a long time and paid up, you know, every single time and taken more loans, but always paid in time, everything, right? You would get the preferential premium client mortgage rate, for example.
Yeah.
Right? And the special black card or the platinum card. Then when I came here pre-financial crisis, like, no, you don't get any of those cards unless you have the highest debt pile with us.
Yes.
Then we might consider you, and if better still, we'll fast track you to a platinum or a black card. If you don't pay it on time, then you pay us loads of interest because you.
You're a good customer, just not in the same way. Yeah.
Yeah. So that was a bit of a shock to the Ong system. Earnings season, I know we've come to a bit of a lull after, but it's always kind of like the calm before the storm. We had some of the tech ones, the big ones, but now we're coming up to kind of like the retail end.
Yeah. The buzz has gone though, isn't it, from earnings season?
Yeah.
I have to say, it always feels it's a bit like Christmas. Once you get tech out the way, nobody really cares, do they? Until Nvidia, for some reason, likes to be the last one or the last sort of major one.
What is it, 30th?
Yes, right at the sort of tail end of the season, just sort of keep everyone's interest. But once, and you've got Disney, you've got Home Depot this week. It's nothing going to set the world on fire. To be honest with you, decent companies, but it doesn't have the pizzazz of the tech sector. Really, you always get the banks. Yes, it's interesting. All the companies, tech, and then once that's out the way, let's move on. And the election. But yes, there's still some to come, really.
I have Nvidia in all of my pensions. Very hard to avoid it, I have to say.
Yeah.
I was poised, but I also wanted to make sure that I didn't, buy the rumor. So I stood sort of ready to react. And I'm glad I didn't change anything. I just kind of stood ready because look at where we are.
Often doing less is the way to go. I think the abiding sin of so many investors is trying to do too much. Too much tinkering.
Yeah.
Oh, do I sell this now? There are a lot of people that would looked at Nvidia back in August, or indeed in July, really down at these down these lows of early August, and thought, is it done? And look at where we are now. We're back up again. And we were saying at the time, here's a dip in the trend. What do you do? There's no sign of it changing trend in any major way. And lo and behold, here we are, new record highs, $4 trillion valuation.
And time again, we see this, don't we, Chris? We get people going, oh my goodness, you know, got to change everything. Or, you know, COVID.
Yep. Yep.
And then, you know, lo and behold, the world doesn't fall off the edge.
No.
It comes back.
So people have been predicting disaster. I think it's a sort of symptom of the financial crisis. Of there's been no reason to predict disaster in any way since the last 15 years or so.
On that positive note, we're going to go to break and we'll be back with Chris Beecham to sort out the opening bell for you. Rise and shine with IG's new morning show, Trade Live with IG, covering all our UK product offerings, including our OTC and exciting new US listed products. Starting in September, join us every weekday from 7:30 to 10 a.m. for exclusive insights from our trade desk, expert trading concepts curated by our friends at tastylive, global guest appearances, and loads of viewer interaction. Regular platform feature highlights and up-to-the-minute market updates. From casual chit-chat to in-depth analysis, we've got your morning covered, live on IG.com, YouTube, and in IG's trading platform. Whether you're a seasoned professional or just starting out, there's something for everyone. Tune in, stay informed, and kickstart your trading day live with IG.
Fundamental analysis is a method of evaluating assets to assess what their prices should be. It's based on the principle that every asset has a real fair value, which may be very different to its current price. It assumes that markets will naturally correct to reflect these fair values over time. The aim is to discover assets that are currently underpriced or overpriced, then place trades to profit from the expected correction if it materializes. Now, unlike a technical analysis that focuses on price charts, a detailed fundamental analysis would look at everything that could drive future price movements. The technique is most commonly used to scrutinize the price of shares, where annual reports, industry trends, and a company's management team may form part of an overall assessment. However, fundamental analysis can be used to review the price of an asset. A commodity like oil, for example, could be evaluated on the basis of economic data, regulation, brand recognition, geopolitical factors, and technical specification, among other factors. But while fundamental analysis is often said to be more comprehensive than technical analysis, it may not give you the full picture. For one thing, it's generally only useful for identifying long-term trends, whereas a technical analysis can help find short-term opportunities. For this reason, it's often a good idea to combine elements of both types to get the most accurate view of a market's direction. To learn more about fundamental analysis, join IG Academy today. It's completely free and gives you access to dozens of trading topics.
Hey, welcome back, you dirty dogs. We are counting down to the open. Just taking you across some of the headlines that we've had in the last few hours. We are, of course, coming into a week when we have still quite a few numbers, but as Chris mentioned earlier, you know, after the tech ones, you know, there is a bit of, and also the election result last week, there is a sort of processing mood going on here in the markets. APEC markets struggling to sustain Friday's momentum from the US when we saw the S&P 500 soar. Tesla, of course, share price breaching that 1 trillion mark last week. Surprise, surprise, after, you know, Trump won and his BFF Musk next to him. Just taking you through, we got less than a minute to go. Some of the things that we're looking at the moment, we have Continental lowering its full-year sales outlook. Also looking at NatWest completing off-market purchase of £1 billion of shares. Direct Line third quarter numbers out, which will get you across in just a second, and also Legal & General completing its multi-million pound share buyback. Moncler also one to watch because if you're scanning the headlines, Daily Mail saying Moncler, here we are, here's the bell with Fred ringing it. What did you say?
You didn't warn me about the bell.
Yeah, ear offenders.
Yes.
Right, we're off. Let's have a look at what is moving. What are you looking at, Chris?
Just looking for, well, let's look at NatWest to start with. Always a very popular one. Huge, strong performer, up 1.5, 1.6, 1.7% this morning. So a lovely start to the week for UK banks. Again, very, very strong performer and plenty of reason for it to go higher. I think optimism around the UK sectors fairly strong. And we know the reaction to the US to the election, of course, with US banks doing really well, but that positivity feeding through nicely to UK markets as well. It's a great hourly chart there actually for NatWest itself, a nice gap higher to start the week. So on what is not really very interesting news, particularly the government continues to certainly reduce its stake, but in really positive, I think, sort of backdrop at the moment, really.
And also it's better than it has been, right? It's all relative here. Deal also the latest step in NatWest's nearly 2-decade return towards private ownership.
Is it that long?
Yes.
It's incredible, isn't it?
2 decades.
If you'd said back in 2007 we're about to see the state take control of a UK bank for decades.
I was stood outside Northern Rock with a whole steady line. This is outside the Bank of England. And the night before, there was a secret emergency COBRA meeting called because they were really concerned that if there was a major run on the bank, there would be Molotov cocktails thrown at the Bank of England. But what was incredible, Chris, was that in that queue is such great diversity. Everyone from stockbrokers to city folk to, you know, people with babies, people in wheelchairs. I mean, it was just incredible. And the line just snaked round the corner.
All waiting to take their money out.
Yeah. It was just horrific. And you're there going, you're next to the Bank of England thinking, how can this be happening? You know, people were enraged.
Yeah, what's that genuine concern that the cash machines would disappear?
Yeah.
There would be nothing left. And that's, not a great moment, really.
Trader friends, any of you remember any memories like that, do ping them across on the comments page here. Andrew McKelvey asking you, question from Chris, why are US markets booming, but the UK market doing nothing? Can you see that changing anytime soon? No,
not really, because the FTSE 100 is deathly dull, unfortunately. In the US, you have Apple, you have Amazon, you have a host of exciting. You have Tesla and Nvidia. In the UK, you have Centrica and Marks and Spencers and Sainsbury's, and it's just not a fun place to be. Despite that, yes, it's cheap. The store is not there. The earnings growth isn't there, and that's why you have the reaction over the last few days has been stark. Really, US markets go nuts. UK markets not bothered at all. Really.
There you go, Andrew. Sake of sounding, mean about the FTSE myself. That's why I don't trade the FTSE.
You should ask Pete Ward. He's a big fan of the FTSE 100, but never really.
If you trade the FTSE, make sure you pair it. That's all I can say. Right. So we're just looking at the markets overview for you because we are just 3 minutes in a trade. Looking overall like a calm day, but just having a look at my list as well. The top of the gainers list here in the UK, Vistry Group. One of the biggest gainers, if not the top gainer at the moment, more than 3% up. Croda International also up 3%. Burberry Group up 2.4%. Now, Burberry, Chris, this is one I trade quite a bit. This is on news, I believe, that we had earlier about perhaps Burberry finding a buyer. And I think
another bid talk?
Yeah, another bid talk. And it's a follow-on from last week. Remember when we heard that perhaps Burberry could get a bid, and it was, I think, Miss Tweed. This was also something that got a blip from Miss Tweed, this
You must be. It must be a site you're on frequently, really.
No, well, you know,
No, you're not a Burberry person.
Can you not tell by my dress sense? You know, can you not tell that?
They should up your dress allowance.
Or give me a dress allowance. So yeah, Burberry. I think it was Daily Mail that was talking about Moncler poised to take over Burberry. That has been sort of bubbling away for some time now.
Yeah, and inevitably with Burberry looking so cheap down here. More than a few bid talks going around, I think, bid stories. And this is the problem, of course, of a market. Again, talking about beautiful trends, this one on the downside, but you get these incredible face-ripping rallies that it goes from £6 a share to £8 a share in the blink of an eye, and yet the story hasn't overall changed. So you probably could expect, if this bid talk doesn't come through, the risk is then it takes another lurch to the downside, and certainly the earnings picture doesn't stack up. And Burberry, of course, is a China story. And you've got China, okay, clamping down on its debt. It's also clamping down on corruption. It's not great for Burberry. Not to suggest that there's nothing behind its business but Chinese corruption. But there's just the turnaround isn't there, especially compared to the bigger rivals like LVMH. They're doing so much better, and Burberry just gets left out.
What I want to know as well is Continental. You know, it's interesting. It should have been a down arrow story, but it is up more than 7% actually. Taking a look at the daily chart there, guys. Do you see a reason why it's up at the moment? Because I believe it was a down arrow story in terms of its outlook, right? Just checking in on the news there. Yeah, they cut their sales guidance, but it did report a third quarter profit coming in at 873 million euros. They beat expectations, but this is the thing. Normally, the outlook is one to watch, and they cut their sales guidance. So
you always watch the outlook. You never really talk about the numbers. No one cares about the numbers once they're out. It's always what do they think will happen next.
Yes.
And that's where you get your surprises, both good and bad. It's in Continental clearly a decent surprise there, although it's shedding some of those gains as we speak. So interesting to watch the DAX particularly at the moment. It's been a seesaw on the DAX the last few days, up, down, and then suddenly again up this morning. Tariffs, of course. The orange man is never... I can't really call him that now, can I?
No.
Sorry. The President-elect of the United States of America. Sorry, I can't call him the orange man. Yeah, that's the key thing for the German stocks at the moment. It's still doing really well.
It's always painfully polite normally.
Well,
seriously, trader friends, it's always such
man
a
on the finger on the red button, you have to be particularly polite. As the Prime Minister is no doubt going to find out, really.
Direct line insurance up 1.2%, now actually up 1%, so it's coming down slightly.
Yeah.
Direct line, you know, coming out saying that its third quarter gross written premiums were about 836 million pounds, call it, versus 1.3 billion year on year.
Yeah.
But look at that chart. This is like, you know, it's just bouncing lower, isn't it?
Well, it had this review, didn't it, earlier in the year, and it's lost direction. And they said the keyword in stop. No. It'll be in my head all day with a little red telephone.
Yeah.
Just don't see that anymore.
That has wheels.
It's for a conversation. Right? Is dating us. Yeah, and it just runs around. Yeah. But so the keyword in the RNS this morning was challenging. It's a word you never want to see in an RNS as an investor. Challenging, which is a synonym for completely dire and worse. Yeah. So there's signs of a little bit of a turnaround, but not much. And it's taken such a beating that you could say almost anything in the RNS this morning and the shares would rise, but the long-term picture is still grim.
Or the other one is searching for synergies.
Yes.
That's the other.
Yeah, I'm a student of RNSs over the years. My rule is always the more stuff they talk about that isn't to do with the business at the beginning of the RNS, the worse the performance is, because it's trying to talk about all the nice things. You know, we had a nice holiday and the CEO's got a new car. By the way, we lost half our business. And that kind of thing always gets tucked away down the bottom of the results. So
it's always like the penultimate paragraph.
Yeah. Oh, and by the way.
Yeah.
Yes.
Yeah.
In case, sorry, but yes, we had.
It's the same as like annual reviews. You sit back and just have your coffee and wait for the but. And then
everything before the but is irrelevant.
And then but. Or like if you go for a presentation, and it's normally the last 5 minutes where the nugget is, right, from the CEOs. The last 5 minutes, not the beginning, it's the last 5 minutes. Monkey Man asking, with Tesco and Asda making comments to the press regarding the budget and profit, do we expect a pullback in companies of a similar profile? I kind of think not just about the budget, Monkey Man, but, you know, have a look at what's happening in terms of the, you know, forward-looking data that you're seeing out from the retail, especially the grocery space. Take a look at the data we're getting out from Singles Day, and everything to me is pointing at flagging consumer spending, especially this side of the pond.
Yeah, even US consumer sentiment's in the toilets, in the lowest levels in 4 years, and yet, and this feeds into the election result. It's how well do you feel better off than you did 4 years ago? It's always the question they ask in the US.
Do you feel better?
No, not really. Then I wasn't voting, but yeah, this is what's feeding through, and I think the Tesco. If you look at Tesco, sorry to take us back to the chart, but you had a huge rally in the share price. It's going to come off for a while. I think there's not much good news around the UK at the moment, and I think the budget makes that more difficult. So it's already taken a bit of a knock, but certainly M&S and Tesco and Sainsbury's warning about rises in inflation prices. That's the word I'm looking for. I think there's more of a hit to earnings, and of course these are thin margin businesses. There's not much of a margin in supermarkets. It's a cutthroat business.
It is a cutthroat business. Our producer Fred asking us to look at Aston Martin Lagonda up 2.7%. Now this is a dog of, I'm going to add this on my work, so this is a dog of a chart.
It is. It's one of those, when we do the morning call that we send out every day, and we do the top 5 movers, risers and fallers, and this is one of those names that crops up both as a riser and a faller, and that's never really a good sign, I think, in the volatility in the share price. You think it would do really well. You think it'd be a fantastic performer. Aston Martin, fantastic brand, massive appeal outside the UK, James Bond, blah, blah, blah. And yet look at where we are in the share price. It's been cheap for years. It's been cheap for a reason, because the performance is just dire. It was IPO'd at too high a level, and the sour taste after that has never, ever gone away. It's
never lifted.
Really.
It's like a bad smell lingering in the room. But today it is higher because of the raise by Citigroup. They raised the target price from a... Wow, they're very confident there, Citigroup. 132 pence from 117 pence. So, trader friends, at Citigroup raising Aston Martin's target price to 132 pence from 117 pence.
What, 10% upside?
Yeah.
Oh, how exciting. Sorry. This is why UK markets don't do well, because it's a dull story. I'm sorry, but that's kind of upgrade. 132, it was at 160, 170 back in September. So we're not even talking about getting back to where we were, really. It's such a grim performance from Aston Martin. Sorry, it's a name that I've seen crop up far too often in the biggest movers. Let's
take a look at the DAX. The biggest movers, Continental, we talked about that already. Trader friends up 7.5%. Hanover Ray up 3.6% as well. And BASF, MTU and Rheinmetall also not having a bad day, having an up day there. Let's have a look at the losers. Daimler Truck and Fresenius lower. The DAX is overall up around 1%, I believe, if this will play ball. Yes, there you go.
Over 1%, 200 points higher. As I say, seesaw moves, and you've had that political turmoil in the DAX in Germany, new elections.
Yeah, we were talking about this on Friday. Do you know why it takes them so long to, once they know that they have to call elections, but it's like, we're not going to do...
Yeah, we're going to wait until March, isn't it?
Until March.
Or is it, no, September, isn't it? I think it's apparently is.
Has it been moved?
Well, from my reading, and I'm conscious that Axel will probably correct me on this, but September's the original date, but if he throws the confidence vote deliberately, then they might bring it forward. I think it's how it works.
Right. Because we were remarking, what a long wait all the way till March. I mean, surely everyone would, be...
Well, it's always coalition governments, isn't it? I think that's the way it works in Germany, really. But Tariffs not really bothering people this morning, up 200 points in early trading, and a nice sort of formation there around 19,000. There's your low there if you want to talk about it and talk about trends. There's your low around 19,000, higher low. Onwards back to, we're only 400 points, not even 400 points off a record high for the DAX, especially when you compare that, of course, to France, where you've had dire performance, poor old France, and the election. It's just never really recovered its excitement since Macron sort of threw that spanner in the works. I don't know what the French is for throwing a spanner in the works, but...
Producer Fred is French.
Well, sabotage is French, of course, so that's where it comes from.
Le spanner.
It's almost as bad as my French.
Is there a word, Fred, producer Fred, who's French for spanner? Throw a
You've got to be able to say it out loud on air, though, as well. If it
he says it's lost in the
it's lost in translation. It's far more poetic.
Yeah.
We say this with our analyst in France, Alex. Whenever he puts technical analysis up in French, it always sounds much more exciting, much more elegant. Technical analysis in Italian or French rather than in English.
Oh, it is what is it? The language of love and diplomacy.
Yes. When I want to speak English, I speak it to my horse. Charles V said.
So taking a look at, speaking of France, let's have a look at my checklist for France. Here we go. The gainers, Safran, Airbus, ST Microelectronics. We have 4 minutes to go, Chris. Legrand, 1.2% up. Hermes also up there, 1.2%. Hermes, one I have a long-term trade on, always seems to, support and be better than the rest of the sector whenever it's slammed by, disappointing stimulus from China or just, less than stellar numbers from the luxury sector. So that's up 1%. Thales also on the winners list. On the downside, we've got Teleperformance and Carrefour there. Hanover Re, just want to check on that for you as well, because Hanover Re earlier had a upgrade to its 2024 outlook. There we go. And like you heard Chris and I talk about, this is not about what we deliver now, but or rather stocks delivers now, but what they say about the future. And Hanover Re here up 3.5% after they gave a positive 2025 outlook, and also after they hiked their 2024 outlook.
Another amazing chart. Sorry, an uptrends. Again, always looks easy with hindsight, or you should have bought it here, but that's a lovely uptrend and throwing off that weakness from August really nicely. So if you'd had the courage of your convictions in August, he says in November, to buy back in again in Hanover, here's where you are. And today's numbers, and again, the outlook is always key, giving it a lot of strength there. So.
And kudos to them too. I mean, these numbers and the hike in outlook, even amid Hurricane Helene and Milton, right?
Yeah, very solid performance. So people love the insurers. Solid cash, dividend streams.
Great dividends.
Yeah, beautiful.
Stock up 13.7% a year to date, around there. The reinsurers, shining, especially Hanover Re. Right. Just taking a look at some of the markets for you, looking like a bid up day here. We are risk on. Having a look at commodities too. Oil, I took off my oil position last week.
What, were you long or short?
I am still in that position.
That's always fun, isn't it? Oh, I thought I closed that one out.
Yeah.
Oh, and it's still there. Oh, okay.
Thankfully, the right way up. I am short.
Good. I think that's the way it seems to be going. I think the mood music there. People...
I did tell you, Chris, Friday I was completely knackered. I just completely...
Well, it's the best time to trade, isn't it? Surely when you're tired. No, that's a joke, by the way. No, in case anyone misunderstands that line. But yes, oil knocked back, stronger dollar, and talk of a Middle East war is always going to push it slightly higher. But it's just not really responding, I think, really. And again, China, the demand isn't there, so that's why oil is still suffering.
How long do you think I should stay in my short position then? I was thinking about...
Where's your stop on that? That's the key. That's the key question we have to ask everybody. Where is your stop? Where's your... in your own time. Find it. It's fine. It's only...
it was at 7,000 for WTI. 7,000, so $70.
Oh, and you're still in it?
Yeah.
I mean, you're still long?
Yeah, and short, darling.
And your stop's at 7,000? Right now, 7,030, so...
Beep, beep. Yeah.
It's fun to work this stuff out live. You see the thought process really laid bare. So, really.
Well, I've got 70 right now as my short term target. But do you think it still is the case that we're going to see more weakness in oil?
Generally, yes. I think there was a lot of talk last week around the Aramco numbers because they're just burning cash to support the dividend. That at some point, Saudi's just have to say, look, we're going to cut production and force the price to go higher. Right. So it's kind of a force majeure kind of moment, really. So watch out for that one. Natural gas up 6% in early trading this morning. So a very, very solid performance for nat gas. Yeah, and gold down 0.5% there. But as we said earlier, gold still in an upward trend there. And it has to be said, Axel and I spoke about this last week. It's hard to come out of that when the upward trend is still quite strong. Do you look at any other commodities? Anyone take your pick this week? Soft commodities? Oh, well, cocoa I know is very popular at the moment, although I think it's not must be liquid stock, but certainly it's liquid market rather. Huge gains, of course, we had right into the early part of the year, and then it's come off since then, really. So struggling to claw its way higher. But commodities, it's such a seasonality thing. You've got to be so up on your supply and demand. Really, it can be very, very tricky on that one. Cocoa is currently doing very well. New York cocoa up 4%. Taking a look at soybeans as well, that's up 0.5%. And sugar, though, is down 2%. Right, on that note, we have to go to confirm and send. So keep sending us your questions on the comments box right here. Chris is also going to join us in confirm and send, and he can answer your questions. Hey, welcome to Confirm and Send with Chris Beecham and myself, Angeline Ong. Rich is, of course, in Edinburgh, and we will hear from him shortly. But this is one of my favorite segments where no question too, hard or tricky. And we also take any questions today, particularly towards, if you want to aim them at Chris. We already had, we take them all. We already had a few this morning. Monkey Man sending a question across. And asking about the pound as well. Your thoughts on sterling? Well, it's a dollar strength story more than anything else at the moment. It's all about what Trump will do, what that will cause the Fed to do. So it's taken an absolute battering, really, the pound against the dollar. We are 129. It feels like a lot of people are still trying to buy the dip in this, but there's not much great news from the BOE, and certainly seems content to keep cutting again. So this is the interesting divergence coming through, because the Fed, they will cut again in December rather, BOE and again, but what happens beyond there is going to be the key thing, because I think you get more weakness in the pound because BOE is still cutting, whereas the US likely maybe to hold rates unchanged for the time being. So that's an interesting one to watch. Okay, cool. Right. Producer Fred, let's hit us up with the first question from our viewers. How important is it to stay updated with financial news? This is really good timing, isn't it, Chris? After last week. Yeah, it is, and it isn't. I think it's very easy when you're an investor and trader to get the runaround. You keep, oh, this is important and this is important. You need to know this. You need to know when stuff is happening. If you're an investor, you need to know when the results come out, when trading statements come out, that kind of thing. You shouldn't let it drive too much in terms of your day-to-day, I think. Particularly if you're a long-term investor. If you're a trader, you need to watch the price action. That's frequently news-driven. But it's very easy to get in the sense I need to have Bloomberg and CNBC on in the background all the time. I need to be on it all the time. You can lead to analysis paralysis, really. I like that. Don't get analysis paralysis. Yeah, it's just, oh, I don't know what to do, so therefore I will do nothing. Let the price action the most important thing. If you're a fundamental investor, then look at the fundamentals. Don't be sort of seduced by every headline that crosses your screen, because it's very easy just to get carried away. Yeah, I think, really.
It's the equivalent of you know, when you first start off with technical analysis and you bung all sorts of lines on.
Oh, I love it. Yeah, you
on the chart.
Get everything you can on there. Get as many lines and indicators. You can't see the price.
Yeah, and then it becomes a spaghetti junction mess.
Yeah. If less is more, think how much more is. Really. But yeah, overcomplicating is another. It's easy to do, and it frequently doesn't get you anywhere. To be honest with you.
But Chris, I have to ask this question because there are some financial instruments that actually are more sensitive to financial news than others, right? So, for example, oil.
Yeah.
I find is very sensitive. So, if I'm trading WTI and certainly Brent, I want to make sure I keep, you know, on top of any sort of news coming out from the Middle East, Russia, Ukraine. Making sure that, you know, you don't miss any large sort of sudden change in the tensions there.
It all gets factored in, though, doesn't it? Really, I think is the key thing. And financial news can lead you to run around too much after moves that already happened as well. So you end up chasing a move, like chasing last week's move in US indices, and then before you know it, you've sort of missed the entry point.
When's your biggest sort of like news related moment? I mean, for me, I can pick one.
Go on then.
So it was when the referendum here.
Yes.
Right? That outcome.
We were on the trading floor overnight and in the morning. It was mad.
Unbelievable. And not just the trading floor and the red, because it's so unexpected, but my phone would not stop pinging from the number of people across the world messaging me going, is this real? Is this a hoax? You remember that?
Yeah.
It was absolutely insane.
52.48, yes. You still bear the scars.
Yes, Chris's, you know, holidays, he's still bearing the, you know, sterling. Also, you hear us talk about it's key to have the guardrails in, and always, like Chris says and Rich says, to be aware of what news is important to what you're trading, right? So not just if it's earnings, then make sure you're across the RNSs, you're across the CEO speeches, but also you hear about Rich talking about, you know, transaction-owned shares of Vodafone all the time. If you want to whack up my screen, show you what he's looking at all the time. And so it's really key that you look and keep an eye out for this. With oil, for example, I'm looking at supply data. I'm looking at what OPEC's saying. And so keeping abreast of what could move your instrument is important. But like we always like to say this to hedge it, and Chris said it best really, make sure you don't get into analysis paralysis.
I wish I could claim that was mine. It's not. I've stolen it from somebody else, but it's a great line. So.
Right, on to the next question. What's the difference between fundamental and technical analysis?
Well, there's a world of difference. I think fundamentals are looking at things like P/E ratios, dividend yields, what they call the fundamentals of a stock, but the things that drive it on that level on the company earnings. Technical analysis is the chart. It's the lovely blue and green and red and green, whatever it is, going up and down. That's technical analysis. Fundamentals are looking at the longer term view, really. I nearly said fundamentally there. Technicals are concerned more with what's happening in the here and now. But the idea of technical analysis is things that were important before in terms of levels might be important again. So that's the difference. One's looking at charts, one's looking at balance sheets, I think is always the way that people approach it essentially. But you don't have to use one or the other, you can use both. I think a lot of the best fund managers will use both.
And we talk about this quite often, don't we? We say to our clients that spend a day with us that, you know, don't use anything in a vacuum. Use all the tools that you have in your toolkit.
P/E ratios are a great one because they talk about, Amazon's P/E ratio is this, it's too high. Well, relative to what? Relative to a company from 50 years ago. Look at Amazon versus itself, Amazon versus the sector, Amazon versus the index. But the index will give you the average. So a company like Amazon that generates so much cash is bound to be at a higher P/E ratio. So you have to, everything needs to be looked at in the context of the broader market, really.
And trader friends, that's why we talk about this a lot, because we talk about guardrails and how to be responsible. So taking a look at not just the fundamentals, I like to kind of think about it this way, Chris. The technicals help us look at the price action. The fundamentals give you a sense of the worth of the stock, an overview of the sector, and the technicals show you how hard to punch it, because you've also got the entry and exit points, right? So those two combined are really good friends and will give you a better direction as to how to improve and optimize your position.
Yeah, but where they also both have the same element is that they can narrow down the universe of stocks and markets that you can trade. Because say you're looking for P ratios, you want a company with a P ratio between 5 and 15 is the old way of looking at it. So instead of having 10,000 companies on the IG platform, you can then filter that down to a much smaller number. So you can reduce the possibilities on offer when you're trading. Because I know when people are looking at the trading platform and you see all the numbers, see all the names you can trade, think, what on earth do I pick? Which one do I go with? Well, that's how you can use fundamentals. In the same way you can use technicals. You can look for stocks trading above the 200-day moving average, that kind of thing. It just filters everything down and reduces the number of decisions you have to make, really.
Out of curiosity, do you have a preferred, if you had to pick one, preferred fundamental tool?
Oh, well, and I started out and I
know Rich likes forward PE.
Oh, right, okay. I'm always a bit sceptical about forward numbers. I think I prefer the backward-looking ones because you can't fudge them.
Oh, controversial.
Well, it's always based on estimates. That's the problem with estimates, if you change them around. I started out very much a value investor, and it was about looking at PE ratios and dividend yields, really, and current ratio. That was a good one. Look at the sort of strength of the company's overall financials.
And this is where I take you to my screen, because where you have your chart, you have this wonderful function on the IG platform where you can go to fundamentals right next to tip ranks and click on that, and it gives you a quick overview of not just the dividend yield but also EPS, and you can get more market data here. And I've been told you can also make this a bespoke page for yourself. But also, if you want to have a look at a cross section of how analysts are viewing the stock, we now have tip ranks, and on the right hand side you can see the analyst consensus, and it gives you a strong overview. Do you ever use this function, Chris? Yeah,
it's a useful one. Sort of again, narrow down a few more of the if you're looking at stocks of particular fundamentals. If you look at the tip ranks and you say if you click on the view more, it will expand the view you get. You can see what the sentiment is. You can see the momentum factors. These are ones that tip ranks have produced, so you're getting a sort of curated view, if you like, on the stock. But it's a quite handy one just to underline what give you an extra element to your trading, particularly. Yeah. Interesting, on the NVIDIA one, it says hedge fund trend decreased. Yeah, it's always hard to say why people sell shares, isn't it? It could be a reason, could be an excessively large part of the portfolio. I remember famously there was an RNS once from Sainsbury's that said the CEO had sold half his shares because he'd had to divorce his wife. So it didn't reflect an underlying comment on his view of the company. It was rather more of a change in personal circumstances. So yeah, it's harder to say why people sell shares than they buy them, really, I think. But still one we're keeping an eye on. And NVIDIA, probably because it's done so well, it will probably be people just trimming positions more than anything else. It does have an insider transaction box as well for those of you who watch this space. I know a lot of our trader friends do. And crowd wisdom, which I find fascinating because it's still positive, but not by a huge amount for NVIDIA. Yeah. Right, so hit us up. Producer Fred, what have we got next? How should one diversify a long-term investment portfolio? Well, diversification, it's making sure you don't have too many eggs in one basket. It's reducing the risk that if you only got 5 shares in a portfolio, then the risk that one of them does really, really badly knocks down the overall average. Or if you've got everything in, say, US tech companies and nothing in I don't know, the dollar or bonds. It means you're so concentrated that you're just risk of one suffering more than anything else. It's the idea of diversification is I don't know which of my investments will do fantastically well. So by having a number of them, it means that I'm assuming that some will do well and some will do not so well. And
how do you deal with that? I'm going to ask SR later. I always have this slight pain when I see my tech basket do quite well, but then because I've diversified, Chris, and I look at my fixed income basket.
Yeah, but it's always easy. When you're winning, no position is ever big enough. And when you're losing, no position is ever small enough, because you always feel I should have done this. And that's the problem with markets. It's easy to look back and see what you should have done. But diversification is saying, oh, I don't know which will do best, so I'll make sure my risk is spread around so that I know that I won't capture the perfect upside, because that would be too risky to have. Or it would be obvious to have had all your money in Nvidia over the last 10 years. But think of the stomach-churning volatility you've gone through during that. Because when it's going up, it's fantastic, but when it's going down, and you would have then sold out of Nvidia and not had anything. So that's also the thing. It's just to spread the money around. It's the old, don't put all your eggs in one basket. The old cliche has a grain of truth to it.
I have indeed, as you can tell by my displeasure with my fixed income exposure. Andrew McKelvey has a question for you, Chris. If you were happy to share, he says, what is your win-lose rate? Woo!
Not fantastic. It's probably about 30%, I think, to be honest with you. But then that's often the way it should be. If you have 10 trades, you don't know which of those 10 will do well and which will do bad. And we're talking about this in the webinar series we're doing at the moment about risk management. You just have to guard against it. That's why you've got stops. That's why you make sure your positions are the right size. So if you do lose, then you're not suffering too big a loss on any one trade. So then a 30% win rate is fine. I think you can do better than that. But it's not a bad thing. You don't have to win all the trades. In fact, you won't win.
You won't win
all the trades.
All the trades. I mean, that would be. We'd all be sitting.
Well, then we'd all have retired by now. Wouldn't be doing
in,
this,
in the Bahamas,
yes.
right? Right. Have we got time for another question? Last question. How does trading futures compare to trading stocks or ETFs? So we get asked this question quite a bit. A very sort of broad overview comparison. Is that ETFs have annual management fees. You're paying for this buffet style, portfolio, right? Whereas, futures, normally no annual management fees. Efficiencies. We talk about efficiencies a lot. Futures margin is capital efficient, usually, whereas ETFs, the margins of stocks, and ETFs, 50% of the value of the stocks or ETF, right? This is usually larger than futures. 24-hour trading access. We talk about access here as well. Futures trade nearly 24 hours, while some firms for ETFs offer after-hours trading. ETFs are generally not 24 hours a day. Any other differences?
No, I think that covers most of them, really. It depends if you're trading with leverage or not as well. That's the key thing to bear in mind. So if you're traditional investing, you're not necessarily using leverage. That's another thing to bear in mind, and the costs involved with that as well, in terms of funding and that kind of thing.
Yeah. And also don't forget, of course, liquidity. Futures like the E-mini S&P 500, treasuries, crude, of course, is extremely liquid. ETFs also good liquidity, but really doesn't have as much mass as futures. So that wraps up our confirm and send. We are going to go for a short break right now. Thank you guys for all your questions. I see a few more coming through. Chris is off. Say goodbye, guys. Trader friends, they're all saying goodbye now.
Bye. Nice to see you all.
Any other questions, do send them across and I will get them asked for you.
Hi, I'm Sean Mearson, Senior Market Analyst at IG, and join us for our new show, Charting Essentials. That's every fortnight on IG.com, our trading platform, as well as YouTube. And that's a show where we look at everything technical analysis, hoping to help you upskill. Whether you're starting out or just looking to level up, we got you covered. In each episode, we'll break down complex concepts into easy to understand lessons, provide practical tips to help you sharpen your chart reading abilities, explore powerful technical indicators and their real-world applications, as well as guide you through hands-on examples to reinforce your learning. So come, let's work on our skills. Let's get better at this. Let's accelerate that trading journey, learn to have confidence to trade, and make informed trading decisions.
CFD trading is the buying and selling of CFDs, or contracts for difference. As a derivative product, CFDs enable you to trade shares, indices, forex, commodities and more without ever needing to own the underlying asset. When you trade CFDs, you trade the difference in the price of an asset from the point at which the contract is opened to when it's closed. As you don't own the underlying asset, you can trade markets that are falling as well as those that are rising. So, how exactly do you trade CFDs? Each contract has a buy and a sell price. Sell prices are slightly lower than the current market price, and buy prices are slightly higher. The difference between the two is referred to as the spread. If you think the market will rise, you would buy. This is called going long. If you think the market will fall, you would sell, known as going short. The more the market moves in the direction you predict, the larger your profits. If it moves in the opposite direction, the greater your loss. CFDs are traded on leverage, which means that you only need a small deposit, known as a margin, to gain full market exposure. So, if you wanted to open a position equivalent to 500 Apple shares, you might only need to put up 20% of the cost. Your profit or loss is calculated based on the full value of the trade, however, which could mean magnified gains, but also magnified losses. So, when trading CFDs, you should always keep an eye on the potential downside. Take care to manage your risk with stops and limits. Visit IG Academy to learn more.
Hey, welcome, Rich. Welcome all the way from Edinburgh. How are you?
Very good morning to you all. How is everyone? That is a great title. You did not give me the heads on that, producer Fred. That's a good one.
Do you like it? Do you like it?
I'll let you off with it since the FTSE's so strong this morning.
Yeah. Now, all of you trader friends out there that have been messaging already this morning, we dearly miss Rich on the show, but he is, of course, on that full week roadshow with Tom Sosnoff and talking options. Just give us the lay of the land, what it's been like so far. And I understand you also had a dinner last night.
That's right. So I jumped on the train after the show on Friday up to Scotland, had a wonderful weekend back home, but then came through to Edinburgh yesterday. And of course, it was the Scotland-South Africa rugby match. So standing room only on the train. But yeah, got through to Edinburgh. And so Tom and our head of events, Brittany McCallum, had just, there they are. There's the full dinner. You can pop that up, and I'll run you through. So, of course, Luke Moore, you'll recognise, the boy band member on the left-hand side there. And then, yeah, that's Tom. That's our head of events, Brittany. And then, yeah, you see me ducking in the back with a little glass of red there to toast everybody's arrival.
Nice. Sharon's there too. Also, what's the mood like over there? What's going on? Any sort of tidbits behind the scenes?
Now, so Sharon, who's sitting on my left in the picture, Sharon is the one responsible for me coming onto the show in the very first place. We had a lunch a number of months ago, and she invited me into the as a client into IG to chat about the potential for future ideas and everything like this, and that results on my wee junket being on the show today.
and also the pleasure of me seeing you every morning. Speaking of
Oh, lucky you, Ange.
lucky me. Speaking of me every morning, this is how much I miss you.
Chris was wonderful this morning, I've got to say.
He was great, and I answered lots of questions, made Andrew and myself, Andrew McKelvey, who's watching the show, feel a bit better because I was saying that, the fixed income side of my, diversification, I always feel a bit, upset when I see that compared to my tech basket. And, Chris said, that's okay because that's diversification. Andrew McKelvey asked him about his risk win rate, and he said around 30%. So that made us feel a bit good about ourselves too. But talking about positions,
I want to hear if Andrew's still got that for Expo on, because up 12.5% this morning. What an incredible shout he's had there from the off. And for Expo really soaring to new highs now, 86 pence a share. Just a reminder, that's the one with the Ukrainian exposure. Just really happy about this strength in the FTSE this morning. I think what it's down to is that you clearly had a fund that wanted to sell down UK exposure over Thursday and Friday, did it very aggressively, tried to get it done by the end of the week. And you can see there, they just absolutely bombarded it in Friday afternoon, which was very painful as I was long those FTSE futures.
So did you do anything to your position? Did you tidy it up at all? Or have you left it?
No, that was, I just think there's such it's really been left behind, hasn't it? I mean, absolutely. I was, I'm starting to come around to the idea that the US markets can carry on going. But what I'm really interested in there is doing some kind of calendar trade. So, in the options market, you can, for example, buy a December call on the S&P 500. But then I'm interested in selling a January call at the same level, because I think it maybe looks like a bit of a, well, up here it's known as Arthur's Seat, or one of, maybe Ben Nevis, in that I think we go higher, and then this, realization of what the valuations look like. And the first step that Trump makes wrong, then, we'll get a bit of a dose of realization. Or as Chris called him, the orange man.
Yeah, but the thing is, his fans, Trump's fans, he can do no wrong. This is the issue. He can do no
Yeah, but
wrong.
Trump's fans aren't the global portfolio managers.
Yeah, I know, but, look at what happened to Marcus the last time he was in power. Let's take a look at your positions.
Well, I think it's the algorithms are following that past pattern from 2016. Okay, so that's what a lot of these funds are now programmed to do. So you're seeing, this huge uplift. And yes, I'm not trying to call the top in it here, 6,015 on the S&P 500, but there will be a dose of realization at some point. And that's actually led me into a couple of trades that we'll look at in a little while in the options market on Friday. But yes, up here in Edinburgh, very excited for the first live event tonight, which takes place at a place called The Caves, Angeline.
Yeah, it sounds really, it sounds a bit dodgy actually, The Caves. Tell us what it looks like.
Well, it's maybe actually do a search for it on your computer there. You'll see it's an incredible venue, very historic.
It's also in a very expensive part of town, isn't it?
Well, tell me about that. The hotel rate last night was £530 for a room.
Wow.
And I don't think you want a tour around the hotel room, because it wouldn't take very long. It's definitely not a 530, but that's of course because all the South Africans are here to watch the rugby.
Right, I've got the keys.
So yeah, but there's the cave.
Yeah.
That's where we're, probably the best one is that top middle, actually.
Yeah.
The top middle picture. That's what it looks like. That's where we're going to be doing the show tonight. So Tom Sosnoff's going to be on stage.
Yeah.
And I'm going to be sitting at the side doing all his trading. We're going to be trading 50 options positions in 50 minutes.
Amazing.
Although, in the taxi back last night, he let me know a little snippet. He said, I only need about 20 or 30 minutes to get the trades on. So it's going to be 50 trades in about 25 minutes. And I'm the one that's going to be doing all the tapping for it.
You're the trade monkey.
That's the polite name for it.
That's the polite name for it. Well, you know, anything's possible with Iron Brew, right? So
that's right. And I'd like to point out that the mini bar in the hotel room has a bottle of Iron Brew in it.
Amazing.
It also has a bottle of Buckfast. They've very much gone into the Scottish tradition.
Nice. So we got loads of comments coming in thick and fast. Monkey Man saying, Rich, you're going live tonight. I said, yes, he is indeed. Also, Andrew McKelvey saying that, Rich, he still has for Expo and added some more today. Woo! And Coach Carter, welcome to the show, Coach Carter, saying hello. He's from South Africa.
Oh, yes. Thank you, Coach Carter. Yeah, you guys, you took us down. Yeah.
Joe,
well done.
We've got a new viewer, Joe 12 Pack, saying, will this cover options? I guess Joe's asking about the show. Yes, it is all about options. And if you guys are going to be there on the Thursday, I will be there too, cheering Rich and Tom on. Rich, because my daughter sees my WhatsApp messages pop up, she goes, so excited to see Rich, but will the black dog be there?
That's unfortunately, Layla is across in New Zealand. That was my my companion during my 2 years stuck out in New Zealand there in Queenstown. But who will be there tonight is nearly 200 people who are interested in options trades. That's exactly what we're going to be doing. We're going to be doing every single option strategy that exists. So
nice.
If you sign up to, we've got Edinburgh tonight, Manchester tomorrow, Birmingham Wednesday, London Thursday, and Dublin on Friday. Still some tickets. They found an extra 10 seats at the back of the chambers. So there is, still some tickets available. You get them on tastylive.com or Eventbrite. But I've got a secret for you, Ange, if you promise not to tell anyone.
Your secret's safe with me, but we are live.
I've seen the presentation deck. I know what Tom's thoughts are on the market.
Ooh, do you know his win rate though? I'm sure Andrew would like to know.
I'll find that out for you this evening. I'll say Angeline wants to know your win rate.
Yeah.
So we're small bearish on the S&P and Nasdaq. He prefers.
He's been bearish on the S&P and Nasdaq since last year, the end of last year.
Feel free to take that up with him, Angeline.
Okay,
He's bearish on gold.
He's bearish on gold.
So bearish on gold here.
Interesting.
And neutral on volatility. And what else jumped out? And bearish Tesla.
Bearish Tesla. Wow. Okay.
Calling the top on Tesla.
See, so gold, I kind of get, because now that Trump is in play and we saw what happened with the VIX, right? You and I kind of get that, kind of get the point that there's a lot less uncertainty now than if we had for example, a recount and that kind of thing. However, Tesla's interesting because I believe I'm right in saying that Tom does own a Tesla.
Really?
One of his two cars is a Tesla. So he's bearish Tesla.
Well, for me and Tesla, we're not far enough up the crazy scale yet. So when a stock is so distorted from reality and is completely ignoring any fundamentals, which I heard you ask Chris Beecham about. I'm interested to hear that he drives a car looking in the rear mirror. And shock horror, you ask a historian if he prefers things in the past or things in the future, then I can understand his answer. But yeah,
just whacking up the Tesla chart as you're talking about it.
Yeah, what I do is I remove the prices on the right-hand side, okay? And I remove those and I replace them with batshit crazy. And I don't think we're quite maximum on the crazy scale yet, because you've just had a weekend, right, where every conversation in the world will have included Elon Musk.
Yeah.
Okay, my brother-in-law was talking about him. My mum even asked me, what do you think of Elon Musk, right? So those conversations have taken place, which means there will be fresh new buyers of Tesla this very day and over the next few days, because that's still, you know, intelligent people that are having conversations about Elon Musk that think that, you know, Tesla's the way forward. So I can still see that it gets more crazy from here. But maybe when we're in the black cab on Thursday going to the event and the black cabbie's saying that he's just bought Tesla, or, you know, maybe there'll be something, there will be a moment that Elon Musk does something or says something, or there's a rumor that he's going to be appointed Treasury Secretary or something silly like that. That will be the moment to sell Tesla.
Where is batshit crazy for you then? Or are you just waiting for that moment? I mean, is there a level?
Well, no, there's no
level?
price.
There's no price.
There's no way that it should be $320, but it is. So it's not a level. It's when you hear the craziest possible thing about Elon Musk or Tesla share price, you know, that Tesla is the new Nvidia, that's you know, that's when you start to think about fading the rally.
Amazing. Good. When that happens, can you message me?
I'll be very happy to after I've got my trade on.
Right, speaking of trades, let's go and have a look at your positions. So the first one, I'm going to put that up right now. Right, I've got your first position up. Talk us through this.
So that's in Boeing. So I've decided to take a bearish approach to Boeing here. And that's because, so that's a butterfly, put butterfly. And I've decided that we saw this strike come to an end and the stock kind of failed to rally.
Yeah.
And remember, you've had $15 billion of new stock go out to brand new investors. And you've had a lot of people try to pick the bottom in this stock, right? Catch the falling knife. So I just think if we do get a bit of market weakness before December and the Dow Jones comes off, then this could be a sitting duck to break that 150 level and it'll go straight down to 145. So I've just had a small setup there. It's a really nice payoff. It's about, remind me, I paid $160 for this and it's for a $10 of downside. So the maximum profit peak is at 135. And yeah, so it's $10 for 160. So what's that, about a 6-to-1 payoff?
That's pretty good.
And I think we could see Boeing there. I don't think it goes through 135. So yeah, it's an uneven butterfly. So yeah, so that's position number one.
Yeah. Let me get position number two up for you. Just give me a sec. So position number two from Rich is on Nike.
So this is on Nike, and this is, I noticed we had some weakness, right? The market's gone crazy, and Nike dropped down to 75.90. So I thought that was really interesting because that's getting back down towards those lows that we had before we saw, you know, the change of CEO. And at some point, there'll be noise about when this new strategy day is. So I said, right, look, I'm happy, very happy owning Nike at 67.5. So I sold the put there and received 69 cents for it. and then I bought a call ratio on the back of that. So this is known as a big lizard, right? It's not a jade lizard, it's a big lizard. And I've managed to buy an $80 to $87.50 call vertical.
But also
on
this is
that. So the total cost about 80 cents, and it's about a 9-for-1 payoff.
nice. And this is quite clever too, because this big lizard also, I guess, takes into account that perhaps we could see some sort of weakness ahead. I don't know about you, but I've been looking at these numbers from like the Adidas and Pumas and everything, and they seem to be saying that they're seeing better holiday trading. But I think what they're trying to say is that they're hoping for better holiday trading. All the numbers that I'm seeing that are coming out from Singles Day, from retailers, all point to weakness because of China.
Yeah, and actually, even more simple than that, I saw a pair of Nikes that I would buy for the first time in 2 years. There was a great pair of Dunk Lows, and they were selling for 90 quid. Now, my main problem with Nike is that the quality has dropped off, the shoe designs have been crap, and the prices have been too high. So for the first time, the price was right, the design was great, and so there's a bit of everything in there, but not, I'm not buying stock yet. I still think there could be something to come out the closet if he kitchen sinks everything, but I wouldn't want to be short Nike anymore.
Right. Well, good one to watch, everyone, trader friends. And Mama McDonald, I know also you took her shopping recently, and she picked up a pair of Nikes, didn't she?
She did indeed. That's a great memory, Ange. She did. I tried to get her into the
Adidas or the
into
Hoka.
the Hokas.
Yeah.
And the Hokas were just a little bit too wild for her.
Ah, see, I do
So,
listen, because
she settled for a pair of Nikes.
I am out, trader friends, Andrew, Monkey Man, I am out looking for a new pair of trainers. So if anyone's got, and Rich too, anyone's got a good tip, let me know. I like good support. Right, Uber, your third position. I like this one. Is this one I'm just looking at, it's another butterfly. Is this another butterfly?
This no, this is the same idea. I'm not sure if this one's got a name actually, because it's similar to a big lizard, but it's actually a call ratio rather than a call vertical. So I'm short double the amount of the 82.5 calls that I am long of at 77.5. So it's saying that I think Uber's had its downside. Right, it had those poor set of numbers. I think it's had its downside. It dropped down to $72, and now I think we could get some upside, but not that much in Uber. So this is me. Both Nike and Uber are looking for stocks that have been left behind a little bit in this latest rally, because if it goes on, I don't have many bullish positions on at the moment in the US. So I wanted to find a couple of stocks that have been left behind that are quality companies. They might just not have had great earnings. And Uber sold off from 85 down to 72. So you can see there, I'm very happy to be long at 62.5. I would buy the stock there for sure, because I think it's a great company. But then I wanted a cheap way in to the 77.5, 82.5 calls. So that structure costs zero. So that's a zero cost structure.
Interesting. So you wanted a way of expressing that view. And I like Uber.
But
go on then. You like, but
didn't want to buy the stock. Didn't want to have the exposure in case the S&P sold off and that came down. So so Boeing is my stock where I think it's going to trade very heavy, and Uber and Nike are stocks that I think, having been left behind, if we keep rallying, they continue to go.
But you won't get whacked in the face if things go sour. Also with Uber, I think the interesting thing with Uber is that if you look at Lyft, its closest, one of its closest rivals, you know, Lyft has been showing signs that it's doing well. And part of this, I think, will also lift Uber because there's this whole return to work trend going on right now, right? And I also feel that Uber's offering, especially in the US and Europe, they are diversifying. I don't know whether you've seen Uber Prime or Uber Gold being tested. Have you seen that? Where you can ensure that you pay.
Certainly not in Scotland. We tried to order an Uber last night and it was about a 10-minute wait.
Oh,
so
no.
that would, yeah, Scotland's not leading the charge on the Uber service. But yeah, and in the time we've got left, you know, I just want to remind people there are tickets left for Manchester, Birmingham, and Dublin. Please come along. It's going to be a good laugh. Tom's major, you know, effort for the night is to entertain people. So there was even talk about free beers last night getting thrown out.
Yeah.
Now there are canapes, but there was some talk about free beers, and I think you get a cocktail on the way in as well. So
nice. Also, is there going to be the last one I was at had a really cool game? Just very quickly, is there going to be a cool game at the end? Is that why you might get free beer if you win?
Don't give away our secrets, Angeline.
Right, very exciting. We'll look forward to patching into you again tomorrow to get the lowdown of how it all went. Good luck for tonight.
Thank you very much. Great to hear from you all. Good luck.
Hi, I'm Sean Mearson, Senior Market Analyst at IG, and join us for our new show, Charting Essentials. That's every fortnight on IG.com, our trading platform, as well as YouTube. And that's a show where we look at everything technical analysis, hoping to help you upskill. Whether you're starting out or just looking to level up, we got you covered. In each episode, we'll break down complex concepts into easy to understand lessons, provide practical tips to help you sharpen your chart reading abilities, explore powerful technical indicators and their real-world applications, as well as guide you through hands-on examples to reinforce your learning. So come, let's work on our skills. Let's get better at this. Let's accelerate that trading journey, learn to have confidence to trade, and make informed trading decisions.
Trading the news is an essential skill for all traders. Major news announcements can often cause large price movements, particularly in Forex markets. So, here are 5 key pointers to help you try and make the most of those moves. 1. Do your research. Know the times and dates of important events. Use an economic calendar, for example, the one on IG.com. It's a vital tool to help you plan ahead. There are many announcements on any given day, and it's essential you know which will affect the assets you're trading. For a Forex trader, generally any event impacting the US dollar is important. Events like non-farm payrolls, Federal Reserve minutes, and GDP. If trading shares, look out for company earnings, dividend payments, and stock splits. 2. Check what the market expectations are for the event. Look at a chart of what happened last time. How did the market react? Was the data better or worse than expected? Did earnings beat or miss estimates? Use what happened in the past to inform your future trades. 3. Study related news and events. What else could impact the market in the wake of the announcement? Take crude oil as an example. US inventories are due on Wednesday. If there's an oversupply, the price should drop. But say OPEC ministers are meeting Thursday. If they reduce output, the price could rise. So, it's essential to look at the overall picture and not take each event in isolation. 4. Put a strategy in place. Know what levels you want to buy or sell at, and where to put your stop losses. This will help you to have the courage of your convictions and avoid knee-jerk reactions. And finally 5. Learn when to fade the news. Here's an example. The CEO of Company X announces he's leaving. The stock falls, but you believe the company's fundamentals are still sound, and the market is overreacting. So you hold your position. If you're right, and the price rises, you could profit. Of course, if you're wrong, and the price continues to drop, you'd make a loss. Remember, these are all just guidelines. While trading the news can be exciting, it is also risky. Unexpected results can lead to high volatility in the market. So, make sure you're well prepared, and always have a solid trading plan.
Hey trader friends, welcome back to Live from the Trade Desk, where we have Axel Rudolph standing by. Axel, how are you?
I'm all right, Angeline. Thank you very much.
How was your
Just
weekend?
having slight issues with my screen here, but
You look great.
it was nice.
You look
Thank
fine.
you. Had the family over, which was always good. And yes, it's getting colder, isn't it?
It is indeed. Hence my woolen scarf. I don't know whether you have the same thing as me, Axel, but if I keep my neck warm, I'm fine during the winter season. But if I don't keep my neck warm, that's it. The end. Kaput. I'll get a cold.
But for me, it's my head. No hair left, so no insulation.
You got some really nice trader friends. If you don't know, he's got some really nice fancy hats, which he carries off very well, our Axel. So, Axel, speaking of carrying something off very well, I listened to your oil outlook last week, and also Chris caught me out because I was so exhausted after election and covering all of that and being on the trade floor that I forgot that I had an oil position on, thankfully the right way. So I'm still short oil, WTI, and I've got a limit at 70 and a stop at 72.30. I'd love your thoughts on where oil is headed.
Well, I mean, I don't know. As you know, I mean, I've been short since last week, and we had that resistance area, which you pointed out with that arrow last week on the show. And we had a move down on the day itself, looked really clever, and then obviously we had a bounce back, but we didn't get stopped out. We remained below our stops, and we're still short. So the short term, the trend seems to be pointing down. Now the question is whether we can hold at last week's low, which might offer support. But if that were to give way, then perhaps we could go back down to these lows you're just pointing out there. So for the time being, I mean, it depends really whether you think the support area from last week is going to hold or not, in which case you might want to take some money off the table, or if you believe that it's going to be fallen through, then you just keep your position on and maybe just lower your stop loss. I mean, IG traders can use a trading stop loss, so you could on the platform or on your phone just lower your stop with the market. So if the oil price were to drop 50 points or so on the spread bet, your stop would be lower by 50 points. So you could do things like that.
Right, and that's a really cool tip for those of you that don't already use this. There's no extra charge, so it's a really cool tip. And I didn't realize as well that you can set it so that each time it does move, it sends you an alert.
Yes, you can get an alert on your phone, or definitely.
Right, so that is WTI. How about gold? How are you seeing gold this week?
It's really interesting because a lot of our clients asked me about gold, and the view is still long-term, long, because as you can see here, we're still in an uptrend. But for me, the line in the sand is the early October low at $2,605 per troy ounce, because basically that low there exactly, because that's the last reaction low above which we're trading. And last week we went down towards that level, but we didn't go through that level. So we still have a series of higher highs and higher lows on this chart, which is the definition of an uptrend. And if anything, you could actually buy gold down here again at lower levels, perhaps with a stop below that 2,600 mark. But if you believe that the gold price could fall further, then obviously if you're short already, maybe stay short with a stop loss above last week's high. It really depends on your view. I heard that earlier on you discussed this with Rich just now about Tom Sosnoff being bearish gold. I mean, sure, you can think that, but it's always a risky thing to do when a market's trading in all-time highs, and we were there 2 weeks ago with regards to the gold price. The odds are, because of the longer-term momentum behind the gold move, that move is more likely to continue in the medium term than any major reversal. Why is gold coming off? Well, basically, the fact that Trump won so decisively removed a lot of uncertainty from the markets, and when that happens, as we saw with the VIX last week, then the gold price does tend to come off, because it's quite often a safe haven investment, isn't it, for a lot of investors? So,
and also, do you factor in, Axel, the fact that with Trump as president, and the view that he's going to really sort of, allow rising debt really to happen, that this will mean debt servicing costs, concerns about sustainability of fiscal policy, and all this will support gold.
Longer term, definitely to bring inflation back. I mean, don't forget, the US is in a very, very potentially dangerous situation, but has been for a long, long time. I believe it is currently, I think it has a debt level of 123% of GDP. And I think it's about 17% of debt servicing. So all the debt it has, just 70% is on the interest on that debt. So that's an absolutely huge number. And obviously, the US debt continues to rise very rapidly. And the buyers of that debt, China, Saudi Arabia, United Arab Emirates, Japan, if one of those in the future were to say, well, we don't want to buy T-notes or T-bonds anymore, who knows what can happen. But this scenario has been in play for many, many years now, and the US is still the dominant market in the world, and nothing changes with that regard until we get to that day where suddenly it does. So I don't know what's going to happen in the future. Nobody does. But if inflation were to once again rear its head, which is very probable if, and that's again a big if, because Trump may say one thing now and maybe not do that in the future, but having said what he did in his first term, maybe he will actually do some of the things he said he's going to do. If he puts tariffs on his European trading partners by about 20% or 60% tariffs on China, of course that's going to create inflation, and that would be probably bullish for the gold price.
Could it be like Japan? I mean, we've seen Japan, consistently up there, Axel, in terms of countries with the highest national debt in the world, and yet it still, continues on. It just continues, functioning. Maybe, the US is going to be like this, where it just becomes this partner. Do you think it's unsustainable?
Long term, I honestly think it's unsustainable, and I do think that everything comes to an end. But long term could be in 50 years' time, so who cares? So I don't know. I mean, the thing is, if you look at Germany, for example, they're very much worried about this everything, which is why Germany's got the lowest GDP to debt ratio, debt to GDP ratio, I should be saying, in Europe. But it really depends. As long as you've got buyers of your debt, as long as you can sell your bonds to foreign investors and sovereign wealth funds, you're fine. And that seems to be the case, and it has been the case for many decades. But there will come a point, well, maybe that will change. But as I say, might be a long way away.
Just a really quick question. I know you want to talk about natural gas as well, but ground
Sure.
on listening in right now, one of our viewers asking you if you have any thoughts on the German DAX. Even though Europe is in the doldrums, DAX is near record highs. So asking for your view on the DAX.
Well, the DAX has greatly underperformed US markets recently, and even the MSCI World Index.
This daily chart, guys.
What hasn't happened, I mean, especially after last week's troubles with regards to the politics and the now upcoming election in March. So it has underperformed. But if you look at the chart, the chart's still bullish, and it's still going up. And as long as we stay above last week's lows, the trend's your friend is still looking very healthy here. So we'll have to see what happens, because if you look at the DAX, it could potentially be forming a top here like it did sort of around April, May time. But for this to happen, and it would become a head and shoulders top. But I don't want to, interpret things that what might happen in the future and so forth. At the moment, the trend's your friend, and it's still pointing higher. If we were to fall through last week's lows and close below them on a daily chart, then perhaps the situation may change. But unless that happens, as you can see again today, we're pointing higher. Now, we have to be careful today because it's low volume trading that's going on, because obviously we've got Veterans Day, we've got the US shot, a lot of traders at least being away, and the same in other European countries like France, for example, being shut, etc. So I wouldn't read too much into today's movement, but let's see what happens tomorrow. Let's see what happens with regards to US CPI inflation, because if that starts to suddenly come in higher than expected, it could dampen the mood at the moment. But let's also look at US markets. I mean, what's really interesting, last week we had the 50th record high this year in the S&P 500. And it did so without a lot of the Magnificent Seven stocks.
It did. And it did it not just without the Magnificent Seven, but it did it without Chinese extra stimulus.
Exactly. So it'll be interesting to see whether the American markets can now rally without the Magnificent Seven. Now, obviously, Tesla has helped tremendously, up 31%. But yes, it's been kind of interesting.
Yeah, just very quickly, Producer Fred, do we have time for natural gas? One last one, natural gas. Take us through your position on that.
I don't have a position, but I have a view. And what we've seen this morning is, if you put a chart up, you can see we gapped higher, and it looks as if we're heading back up again towards the 3 level on the front-month futures contract. And here we had a nice bounce. You can see this gap. A gap is simply when you've got a hole on your chart between the high and the low. You can see that high there exactly from Friday, and then the lowest point so far. So when that happens, you can have one of 3 gaps. One is a breakaway gap, when you get a new big trend to the upside forming, for example, in this case. One is a measuring gap, which this one isn't. It's in the middle of the movement. And one is an exhaustion gap, which you don't have here either, because that happens at the top of a move, a bottom of a move. And here we've just sort of traded sideways to up, and we're just capping higher. So yes, short term it is bullish, but quite often these gaps get filled. So perhaps that could be an interesting trade if we were to go back towards that 3 area, and then perhaps we could go short there. We'll have to see.
Not this time because we're running out of time, but some of our trader friends saying they'd love to hear you about how to trade gaps in our future programs.
Sure, anytime.
Thanks so much, Axel. I'll leave you there.
Thanks,
and we will patch in with you sometime later in the week.
Okay, great. Thanks, bye.
Bye. Right, we're going to just go to a 5-minute break, but stay tuned because we will be back with ISA and market measures.
Corporate earnings reports are quarterly reports that reveal the financial results of a public company. They include valuable information such as revenue, net income, and earnings per share. Investors can use corporate earnings reports to gain insight into a public company's performance. They help investors decide whether it's time to buy, sell, or hold on to shares. So, how do corporate earnings reports impact trading? 1. They affect market indices because indices are made up of publicly traded stocks. Index values go up or down based on stock price movements tied to company earnings news. 2. Corporate earnings reports can signal a healthy or unhealthy economy. They could influence central bank decisions on interest rates and monetary policy. 3. Unexpectedly positive or negative reports have the potential to induce volatility in the stock's price and prompt activity in the market. 4. This surge of trading activity could result in more liquidity. It becomes easier to enter and exit trades when there are more active buyers and sellers. However, increased volume can also introduce greater unpredictability and price swings. 5. Positive reports can bring in foreign investment to a country's market. Negative reports could make foreign investors less interested and reduce their involvement. 6. An earnings report has the power to sway how investors feel about a company or the market in general. How an earnings report impacts the price of a stock depends greatly on what investors expected. If earnings exceed estimates, the price tends to go up. If earnings disappoint, the price often drops. Meeting expectations is key. Even good news might sink a stock if investors hoped for better news. Likewise, a stock could jump if bad news wasn't as bad as predicted. So, how do you trade corporate earnings news? The challenge is to work out how you might react to news that will thrill or disappoint investors. Have an action plan in place for earnings that exceed expectations, or earnings that might disappoint. There is also a chance that the earnings might be exactly what the market expected, and there won't be much price movement at all. Keep in mind that the market can be unpredictable, and these changes can happen in a flash. Option strategies can allow traders to trade big price swings in either direction. Strategies involve buying both call and put options on a stock prior to the report. Call options can protect short positions from rising prices, while put options can protect long positions from falling prices. Finally, it's essential to have risk management practices in place, such as an airtight trading strategy, stop-loss orders, and portfolio diversification. Consider bird's-eye view factors like industry trends, the health of the economy, volatility, revenue growth, and trader sentiment. With preparation, agility, and risk management, you're on your way to trading corporate earnings news effectively.
Hi, I'm Sean Murison, Senior Market Analyst at IG, and join us for our new show, Charting Essentials. That's every fortnight on IG.com, our trading platform, as well as YouTube. And that's a show where we look at everything technical analysis, hoping to help you upskill. Whether you're starting out or just looking to level up, we got you covered. In each episode, we'll break down complex concepts into easy to understand lessons, provide practical tips to help you sharpen your chart reading abilities, explore powerful technical indicators and their real-world applications, as well as guide you through hands-on examples to reinforce your learning. So come, let's work on our skills. Let's get better at this. Let's accelerate that trading journey, learn to have confidence to trade, and make informed trading decisions.
Love this jingle. Welcome to Market Measures, one of our favorite segments here where we take a look at the numbers behind the thinking and how we look at positions and how we optimize our positions, right? SR Batterjee is here with me, Head of Organizational Development here at IG. We'll get to him in a second, but let's have a look at the probability and number of occurrences. Right, let's hit up the chart. So here we are. We've got this from Sahil all the way from Chicago, and it's about looking at the law of large numbers. The average of the results obtained from a large number of trials should be close to the expected value and will tend to become closer as more trials are performed. For example, we talked about this a lot in casinos. They usually have a max bet, right? And this is to prevent you from placing too large a bet and getting lucky. That rather you bet many times and a smaller amount each time, because the law of large numbers run in their favor. This is in the house's favor. Similarly, trade small, trade often is a trader's mantra, and the number of occurrences does play a huge role in trading. So why is that? Let's have a look. In the first 15 days of May this year, SPY has never had a down day, meaning if we were bullish, we would be correct every day. Here's a look at the average percentage change, 0.5% win rate, 100%. However, this doesn't necessarily mean that a SPY position will go up every single time. The same as we don't ever win every single time. There are always deviations. So how do we minimize them? Well, first, let's explain deviations and consider the following portfolio with majority winners. It is highly possible that in a sample of 3 trades, they're all losers circled in blue. However, with more occurrences, the results tend to be closer to expectations because we simply capture more of the data. Which brings us to this chart. What do you think of this chart, Essa?
So I think, yeah, this is, I think, a perfect illustration of exactly what you were talking about earlier. So when you start to look on a much longer time horizon, you can see that roughly the number of green dots, the ones above the line, are roughly equal to the number of red dots, the ones below the line. But if you look at any very small amount of time, you might be able to see a slightly biased selection where they're kind of skewed bullish or skewed bearish.
And also what's key is looking at the, you're absolutely right there, because if you look at those periods, the 2020, that's the COVID period, right?
Yeah.
And it did, everyone was so worried, and you know, those, you heard Chris and I talk about it earlier.
Yeah.
There was pandemonium, you know, people saying, what do we do with our portfolio now? But over time, I guess what we can take from this is the world, at least in the financial market sense, over a long period of time, it rarely tends to just fall off a cliff.
Yeah, and actually you can see, I think the COVID era is a really great example where those market conditions led to higher volatility. And so you can see actually the size of the spikes in both directions are bigger, but the actual number of spikes in both directions is roughly even as soon as you start to look exactly like you say on that slightly longer time horizon.
And same here, I guess, with the GFC as well. So let's have a look at the next slide here. The market experiences large changes when sampling a small number of days. However, when the number of days increases, we experience mean reversion. The average percent change in SPY and standard deviation of percent changes is lower. So the longer we stay in the market, trader friends, the more our returns will level out, cancelling out any huge chances to the downside over time. So here in this handy chart that Sahil has made for us at the bottom, he's calculated 10 days, 100 days, 1,000 days, and all days. And you'll see the figure, the standard deviation percent change in a SPY. You can see that coming right down from 1.07% to 0.19%. Similarly, also at the top, 0.21% for 10 days. This is the average percent change in the SPY, and that also comes down if you go down on a longer period. Right, what do you think of this chart, Essa?
Yeah, I think this is, again, I think highlighting the same thing, which is actually the longer the time horizon you're looking at, the lower your level of variance over that entire time period. So I think as you increase the number of observations, you can see actually the overall volatility that you're dealing with kind of starts to stabilize. And that can be good, especially if you're worried about long-term risk management, but it can be bad, I guess, if you're looking for that volatility to trade against.
And on the options front, we always hunt for volatility, but trader friends, like Issa rightly said, if you're looking for more stability and more of an investment side of thing, you want to, be in it for longer, because statistically it will even out any of those big moves. So, Issa, take us through the takeaways.
Yes, so I think all of this collectively is really important, because we need to remember that we're trading in this random, slightly stochastic environment where stuff might happen that's unexpected. And even though we have expected probabilities, it's still going to take a little bit of time to realize those results. And if we have a small sample period, we won't be as confident in seeing those average results that we'd expect to see. And so if you want to trade small, then actually you'll be able to get a much larger number of occurrences, and over time that can help reduce the amount of randomness and the amount of probability that we're having to deal with, and it can help us manage the risk and maintain our capital in our accounts.
And I love that word that you just used. We seldom hear it enough, stochastic.
Yes, yeah, it means, yeah, they're just random. Right? Exactly, and there are events that we can't predict, whether those are news events or whether those are actually kind of information drops, things like earnings or things like market releases. Those are things that the market tries to price in as well as it can, and they price in expectations. And so the randomness only comes from where there are differences versus those market expectations.
Issa also has this really impressive, calm voice. That kind of, makes you, it's all going to be okay, guys.
Yeah, all evens out in the end.
It's all fine, and don't run for the X. It's great. It's a gift. Like Mark Carney has that voice.
He is a very calming influence.
He was such a great central banker. But also, Issa, talk us through, like, this also highlights the difference between trading and investing, right?
Yeah.
So, and you talk about psychology all the time. I mean, how does this feed into, how we should be looking at trading psychology?
Yeah, so I mean, we were talking about it just before the show, but if you have these periods of large volatile swings, if you are an emotion-based trader or investor, you're more likely to make decisions in those kind of heightened swings. And actually, especially if you're someone who's trying to buy and hold for the long haul, that short-term volatility, you have to get very comfortable with the idea that if you hold it for a much longer period of time, you actually will kind of even out that volatility. And if you feel emotional in the moment in some of these kind of long-term investments, you might make bad decisions that kind of end up penalizing you in the longer term compared to if you were to just kind of buy and hold.
Yeah. And I guess that works well in the kind of pension side of things, right? Longer term. Kind of why I was saying that I felt really nervous about last week.
Yeah.
But I wasn't going to move until we had clarity as to who was in the administration.
Yeah, and actually there's funny studies that look at the amount that people check their investment accounts. And basically what they find is if you are someone who's trying to buy and hold for a really long time, the best way of being happy is to almost just not check it. And I think it's...
Chris Beecham will love that you said that.
I know, yeah. but the opposite actually is true for trading, actually, where you're trying to take advantage of some of these moves and these swings. And so then your behavioral kind of approach to absorbing that information might be extremely different. And so if you are one of these kind of longer term investors, it might be sometimes in your interest to check it less frequently, I think, than if you're a trader with a shorter term time horizon.
That's right. And Issa's touched on a really good point there. Lots of different people with different risk appetite. Your risk appetite is different to mine, and it's different to yours too, trader friends. I know Andrew has got a great risk appetite and good call on for Expo. But, I got a bit nervous because I told all our trader friends that are watching, I check my longer term portfolio once a year. I use Halloween as my sort of like, hey, it's
scary day.
Yeah, scary day. Now time to check. But because of the year that it was, because the election came after, I waited for a bit. Rich is different. Rich, for his longer term portfolio, he says it should be checked as many times as you go to the dentist, right? With extra trips in between if something unexpected happens, like you need a filling or you need. So I thought, am I not checking enough?
I think it very much depends on what your approach is to that portfolio. If you're someone who, for example, has, like we say here, smaller position sizes that you tend to manage on a kind of more consistent medium-term basis, that might involve you checking slightly more frequently than if, for example, you just own S&P or NASDAQ and you're kind of in there for the long haul and you just want to wait.
Yeah. What do you think is going to happen with the S&P? I mean, you talk about, and I'm really fascinated by this because I read your grit and when to know when to quit. And it's fascinating. I'll share this with our trader friends after this. But, you know, with the S&P hitting these levels, right, it's really hard to kind of go against the grain. So, you know, from obviously I try and strip as much emotion out as possible. Yeah. But, you know, at some point, it's going to turn. So how, from a trading, so this is me as a short-term trader. How do I decide to kind of whether or not we get, you know, another high? I'm just going to come out of it now. I mean, that's a really hard call when momentum is so far on the bullish view.
And it feels horrible being wrong.
It feels horrible.
Yeah, I think either side feels uncomfortable. You don't really want to be putting money in at these valuations, but at the same time, you don't want to lose out on the potential gains.
Exactly.
Yeah, I think that's part of the challenge with the current market landscape. I think if you fundamentally think about some of the big investors, you look at people like Warren Buffett, who are increasing their cash piles, even stopping paying dividends and stopping doing share buybacks to try and kind of support the share price. It can really feel like it's a time now where those valuations are very rich. I think one thing I've started to do is actually start to protect downside by buying puts and just having a bit more kind of a balanced view towards risk rather than having kind of what would be a traditional kind of buy and hold portfolio where I'm just long equities. I might just try to provide a bit of protection or insurance.
That is great advice. I've been doing the same on NVIDIA as well, which I talk about a lot here because I'm starting to get uncomfortable. But that's great advice from Esa Batterjee, head of the organizational development here at IG. If you are uncomfortable about still being long, think about different strategies about stacking it and optimizing the trade and stacking it in your favor. We'll be back after the short break.
Hi, I'm Sean Mearson, Senior Market Analyst at IG, and join us for our new show, Charting Essentials. That's every fortnight on IG.com, our trading platform, as well as YouTube. And that's a show where we look at everything technical analysis, hoping to help you upskill, whether you're starting out or just looking to level up. We got you covered. In each episode, we'll break down complex concepts into easy to understand lessons, provide practical tips to help you sharpen your chart reading abilities, explore powerful technical indicators and their real-world applications, as well as guide you through hands-on examples to reinforce your learning. So come, let's work on our skills. Let's get better at this. Let's accelerate that trading journey, learn to have confidence to trade, and make informed trading decisions.
Trading the news is an essential skill for all traders. Major news announcements can often cause large price movements, particularly in Forex markets. So, here are 5 key pointers to help you try and make the most of those moves. 1. Do your research. Know the times and dates of important events. Use an economic calendar, for example, the one on IG.com. It's a vital tool to help you plan ahead. There are many announcements on any given day, and it's essential you know which will affect the assets you're trading. For a Forex trader, generally any event impacting the US dollar is important. Events like non-farm payrolls, Federal Reserve minutes, and GDP. If trading shares, look out for company earnings, dividend payments, and stock splits. 2. check what the market expectations are for the event. Look at a chart of what happened last time. How did the market react? Was the data better or worse than expected? Did earnings beat or miss estimates? Use what happened in the past to inform your future trades. 3. Study related news and events. What else could impact the market in the wake of the announcement? Take crude oil as an example. US inventories are due on Wednesday. If there's an oversupply, the price should drop. But say OPEC ministers are meeting Thursday. If they reduce output, the price could rise. So, it's essential to look at the overall picture and not take each event in isolation. 4. Put a strategy in place. Know what levels you want to buy or sell at and where to put your stop losses. This will help you to have the courage of your convictions and avoid knee-jerk reactions. And finally, 5. Learn when to fade the news. Here's an example. The CEO of Company X announces he's leaving. The stock falls, but you believe the company's fundamentals are still sound and the market is overreacting. So you hold your position. If you're right and the price rises, you could profit. Of course, if you're wrong and the price continues to drop, you'd make a loss. Remember, these are all just guidelines. While trading the news can be exciting, it is also risky. Unexpected results can lead to high volatility in the market. So, make sure you're well prepared, and always have a solid trading plan.
Hey trader friends, welcome back, and we are going to tell you about what's next. What are all the trading opportunities? And with us to do that is Tom Roberts, our Supremo from the PCM. Just starting off with just our trading session here first. What's the mood been like so far, Tom?
Morning, Ange. It's been reasonably quiet after last week's events. We've had everything pretty positive this morning in the blue. I think we're just looking here, seeing FTSE up 0.8, US tech futures are up 0.3 as well. I think definitely the mood is still of a positive nature, but it's not quite as busy as last week.
Yeah, and positive even with, you know, the US 500 at such highs, and also we're seeing, you know, obviously that Tesla move. Do you think it's overdone, or do you think there's more to come, this melt up?
More to come.
Right.
New highs, blue skies, keep on going, trend's your friend, but...
And just long-term portfolio likes the sound of what Tom's saying here.
I think, you know, I think there's been cash sat on the sidelines for a while, as I've said before. I think money's coming into the market. Markets definitely feel they've still got the frustration by China, by what the US-Beijing relationship's going to look like, what Trump's tariffs going to look like. You know, there's been a lot of rhetoric, a lot of talk about it, but nothing's actually been said. So I think we'll wait and see on that front. But everything seems reasonably positive this morning. And, you know, commodities, we've been having a quick look at that. I know we've spoken about gold before. That's come off a little bit. In traditional terms, when that comes off, money flows back into the equity markets as well. Oil, especially WTI, US crude, as we call it, a little bit softer this morning. So as you look at those flows of money on a Monday morning, you can see that the commodities have softened a little bit. The equity market's still a bit stronger. People still are, I would say, buoyant from last week, especially on the other side of the pond. But you know, we'll wait and see what earnings looks like this week as well, and what macroeconomic events may come about Wednesday, Thursday as well, with some of the numbers that are coming out.
Right, that's great. And whilst Tom's been talking, I've just been stopped out of oil. You know, take profit there, but it has breached that you know, 70 level that I was looking out for, and it's gone past 69. 69.72 and now 69.36 as well. So I might go back in on a sell again, just a nibble there, and just tidy that up in a bit, because I think we could be seeing another leg down based on that. Let's have a look at all sessions as well, because that is up and trading right now. Of course, 48 minutes in, we got on the winners, Mara Holdings, Coinbase, you know, the crypto. We heard Trump saying he wants the US to be the epicenter of crypto, the
heart of crypto.
Yeah. So
I mean, Tesla climbing this morning.
Wow.
You had a look. I mean, 5.5%.
You know, it's BFF.
I mean, it is. You know, it is absolutely flying. Nvidia up a little bit. Coinbase obviously doing well on the back of the weekend story on Bitcoin, breaking $80 and then going up to higher. Coinbase up, I think, 15% pre-market now. I'm just having a quick look here. Yeah, $312, give or take.
Yeah.
MicroStrategy following suit as well on the back of that. So, you know, we'll see. But most of the main names, as we talk about, Ange, with our clients, Amazon, Meta, all positive this morning. Apple pretty much flat as well.
Yeah, I mean, it's a bid up day, isn't it? Look at that. It's just, you know, Palantir, Reddit, all higher, Novo Nordisk as well. On the downside, Supermicro Computer and Plug Power, but pretty much it's skewed towards risk on. So let's have a look at this coming session, and of course this week as well. Tom, what are your clients telling you? I mean, CPI, the big one of the week?
Yep. As we've mentioned before, CPI, large interest in that. That's going to be Wednesday. We've got some Fed speakers tomorrow, Fed speakers Wednesday, Thursday as well. Powell, I believe we're hearing from on Thursday. PPI on Thursday as well. But another one for me is on Friday, which obviously traditionally sometimes a bit of a quieter day. UK GDP coming out Friday morning, 7 a.m. Have a look out for that. Retail sales, US retail sales, always an end of week favourite. But as you say, the rate on Wednesday, the inflation rate on Wednesday will be the important one for this week from the macro point of view.
Cool. And then from the UK, we also have AstraZeneca. Lots of mood music there from, you know, the clients you're speaking to. But Astra's
one of our popular ones on the IG client base. Probably one of our top 10 stocks as well. Vodafone as well tomorrow.
Yep.
So two of the main names, but Astra just trading below that £100 mark at the moment. I don't know if you've got a chart up on it,
yep,
but
here we are. Here's the daily chart for you. I think because I traded
big sell-off in light of recent times. We'll wait and see what comes out of their numbers tomorrow.
Yeah.
But it's currently trading 99.70, so we'll see if it has some good numbers and pops back up.
I'm thinking perhaps more weakness, more pain ahead for AstraZeneca before we see the good times roll again. Certainly, you know, it's been struggling like many others after they came off those, you know, COVID vaccine boom, right?
Yep.
And so, you know, it's all about what's in the pipeline. AstraZeneca, you know, not as strong as some others on the oncology front, so it has to also prove its mettle there. We saw quite a huge bifurcation in the last few years, Tom, like some of them, these stocks going for the obesity, diabetes side of things, and others going for oncology. And because they had to kind of focus their power, their firepower, it's interesting to see those winners and losers. Early on, it seems like the diabetes and obesity drugs were the winners. But how about Vodafone? What are you hearing on the ground on Vodafone?
Vodafone's always been a traditional one that our clients like. It's obviously one of the main stocks in the indexes. When clients first come to IG, it's actually one of the first equities that people have a look at just because of the familiarisation with it. Vodafone, for me, has been a reasonably sad story of late. And when I say of late, of the the short to medium term, the last sort of 18 months, hasn't performed as well as it could. It hasn't captured as much as the market as I think it hoped to. But it's still one of those traditional stocks. Everybody will have it in their pension. Everybody will continue to have a look at it.
Good divi stock.
It's a dividend stock, but also it's still seen partly as a continued UK growth stock. So, you know, trading 72.5 pence this morning, very small positive there on the chart from this morning. But overall, it's you know, it hasn't performed particularly well. If you look at it over the last 18 months, 12 months, it's not been one that's been particularly in vogue.
It's been quite painful, that slide.
I think losing market share hasn't helped. I also think some of their foreign transactions maybe haven't gone quite as well as they could have done with some of their purchases in Europe as well.
Remind me, I think it was Turkey, isn't it?
And Egypt as well, yeah.
Yeah. So waiting on Vodafone as well. And then, you know, lunchtime we get some of the retailers. I know Chris and I are saying that, you know, after the big tech names and the Mag 7, the market kind of goes after a while. But we do have, reminder trader friends, we do have the retailers coming up. So you've got Home Depot.
Correct.
Yeah. Is that one that...
it's not, it's sort of, people trade it. It's not the most popular stock, just because it's quite a domestic name over there rather than one of the more international well-known names. But yeah, I mean, it's had as you can see from the chart, it's had a good run of late. I think Cisco on Wednesday might be a bit more popular with our client base. Just having a look at Cisco, it's one that the clients have certainly traded both the underlying, but also Cisco options as well. People have been buying calls on Cisco options for a while now as well. You can see from recent times that it's had a good upward trend as well.
That's a really good run there. You know, strong sort of upward-looking chart since around August time as well. Cisco also, I believe, expected to come out with good numbers, right? I'll tell you one that's good when you talk about options. One that is good to kind of buy puts on Disney.
Disney?
Yeah.
Thursday we're going to see Walt Disney's results.
Because to me, this is still a price action that tells me there is potentially further. It has climbed a bit, but I struggle to see how this has much upside to go, because you know Walt Disney has a wonderful brand, but it has been struggling to try to find its footing, its identity again.
I mean, it's back up to July levels if you look on the chart. I think the new Star Wars film trilogy that's in the works at Disney, I think that could be interesting for them. I think there's a few lawsuits, unfortunately, going against them as well at the moment. So, you know, it's one to be aware of. I don't think their brand is as strong as maybe it traditionally could be.
Yeah.
But we'll see from their data on Thursday what they come out with, and also forward-looking what the management are going to say and what they're looking at going
Totally,
forward.
that's a good point. You've pointed out the management. I mean, there's been a heck of a load of shake-up there. Also on the Disney Plus side, you know, the competition is relentless, and they have not managed to break through the ranks of like Netflix. Their parks don't really like the numbers or the future mood music coming out of there. Did you hear, Tom? They're looking to get rid of the human welcome party.
Correct, yeah.
And to replace all that with, you know, AI, and try and sell you your monogrammed stuff as you line up in that 40-minute queue, if you're lucky.
The way of the future, they call it.
Yeah.
We'll wait and see when the machines come.
Are you real, Tom? Are you real?
Exactly.
Yeah.
Exactly.
Disney.
I'm not a Disney person per se. Maybe my kids are too old for that, but they, you know, Disney subscriptions, I think that Netflix have worked very hard, Amazon Prime have worked very hard on improving their brand, improving their subscription model.
Yeah.
Disney is definitely appealing to a wider audience, but it's also a younger audience, which can be quite fickle as well. So we'll wait and see what Disney Plus comes out with and what subscriptions look like. But their business units, I think, need an overall look at.
They do. And also I'm not a huge, Disney fan too, but I do find the whole stock and the price action, I have traded it, fascinating because, they've got such a strong brand, but, so many things are changing for it at the same time. Have you seen their cruises as well?
Yes.
Yeah, and the amount of money sunk into that, but, it's too expensive for a wide demographic. I mean, they're almost like positioning that for people with child-free lifestyles.
It's also not a continuous model.
Yes.
I feel it's a one-hit wonder. You go on it,
Yeah.
whether you like it or not, that's entirely up to you.
Yeah.
But I don't think they get repeat customers doing that.
Yeah.
And if they do, that's got a huge drag, and it'll be very small as well, I should think.
Yeah. Right. So 1 minute to go. Is that right? Less than 40 seconds. 40 seconds, Tom.
Burberry Thursday. Keep an eye on Burberry Thursday.
Yeah.
I think Burberry's interesting. From the retail that you mentioned, Ange, WH Smith as well. Keep an eye on them, reporting Thursday as well, I believe. As I said, the GDP data for the UK out on Friday, I think is one for traders to keep an eye on as well. And obviously Wednesday's inflation rate we'll keep an eye on as well.
Totally. Quick question before we have to go.
Sure.
What is your evening looking like in the Tom Roberts household?
Tonight, a bit of gym, and then gym,
So
then birthday tomorrow.
No, your birthday.
Yeah, and then
A big number?
no,
milestone?
very dull. 47, very dull. And then Tom Sosnoff special in Birmingham on Wednesday. I will be there.
Nice.
Looking forward to that.
Nice. You're going to be there on Thursday.
Wednesday
London.
and Thursday. Thursday
there.
London, Wednesday Birmingham.
Lovely. So trader friends, if you're at the Birmingham event, do tap Tom, say hi to him.
Please do.
Please do. And also on Thursday, look out for us. We will be there in force. And on that note, happy Monday. Happy trading, everyone.
Thanks very much.
Tomas, we're back, my friend. You know what that means. Time for a little bit more Tasty Live. That's right. Coming at you with this market measure.
Looking at some of these stocks, the NASDAQ looks a little bit weak, but...
Not if you're looking at Tesla.
Or Coinbase.
Or Coinbase. You are correct. But you are right. The NASDAQ, Mr. Obvious, is down 52.
Yeah, I'm mad about my Tesla position. Not happy.
Yeah, get in line. Me too.
Yeah, I know. Baba getting whacked today.
Baba is getting whacked today. Baidu also. Baidu down 360.
I know. Baba getting whacked, and all the Chinese stocks. I haven't looked at. Let me just see. Where's my? Yeah, that's a pretty good.
Beatdown.
Pretty good beatdown. I rolled down some calls. Rolled down some calls in Baidu just for the hell of it. All right, let's do this. The bond move is saving our butts today. Bonds and notes. We've been talking about it nonstop all week as being the best play on the board, and it wasn't without a lot of pain, but it did turn out to be a good play. But it was with a lot of pain.
Yep, agreed.
And it probably saved us from getting short stocks, which would have been worse.
True that.
Yeah. Crude oil down $2. I don't know if you're watching it. Pretty big.
Yeah, big move in crude oil. I'm kicking myself. I don't have a crude oil position. I want to put something on with the IV rank so high, and I didn't do it.
There's plenty of liquidity in there.
Mm-hmm.
So you can pick your poison.
Yep.
I've been adjusting positions, and the U.S. dollar is also a little weaker today, which is good for us.
Yep.
Anyway, let's do this. This is a market measure, but right before we get into the market measure, just real quickly, This is my last time to mention next week because we're going to be on the road heading to Europe tomorrow for 5 shows. First one's in Edinburgh, which is going to be awesome. And these are small shows, so they're not going to be crowded. There's not going to be a ton of people. You can ask questions. You can see the screen. You can see what we're doing. We're just gonna try to trade like a crazy person for about an hour. Hopefully the markets will be busy. I know Monday's a holiday, but I think the markets will still be pretty good. Volatility's high enough.
Futures markets are going to be tight.
Yeah.
I mean, you've got banks closed and you've got the electronic market open, only in the bonds, right? I mean, the open outcry's closed in the bonds. Everything else is open. I think it's going to be another day as usual. Maybe a little lighter volume, but another day as usual.
I agree. Anyway, Edinburgh on Monday. If you haven't signed up yet, tastylive.com/events. Manchester Tuesday, Birmingham Wednesday, London on Thursday, which is sold out, and Dublin on Friday, which I believe is also full now. But again, they're all smaller shows. But Edinburgh, Manchester, Birmingham, London, Dublin, I can't wait. And we're going to have some fun over the next couple of days.
Beautiful.
We're taking off a bunch of bonds and no positions today, so we don't have to worry about traveling with a ridiculous position on.
You won't have to worry about the bat butchering your position.
I don't have to worry about the bat butchering my positions, yes.
You're so cute. You really are so cute sometimes.
08 now in the bonds. Need to sell some at 10.
Oh, how about 09, my friend? 09.
09s. I need to sell some at 10 and I'll be
God, you're making so much money there. You don't even care anymore. You're giving away ticks.
Be very happy.
And I'm the butcher.
All right. Let's hope this all works out. Let's do it. Anyway, tastylive.com/events. The bat will be here all week next week with Nikki and the rest of the team. So we'll have a full house in studio, and hopefully I can live stream some stuff back to you. We'll see how that goes.
Oh, that'd be awesome. Be fun to see you.
Hopefully.
Yeah.
Fingers crossed. We get some live streaming going. All right, let's do it. Market measure, please. So what comes after earnings? What comes after earnings? Let's take a look. Do stocks go the way of earnings, or do they go the other way?
I believe after earnings, I believe they trend sideways for the most part. I mean, I think depending on and again, I haven't seen this, the study set, I would say it was sideways to higher just because we're at all-time highs, Sosnoff.
So the question is, if you have an earnings report that's in line, obviously afterwards the market's probably going to do, the same as it was doing before. But if you have a stock that has a really good earnings report or a really bad earnings report, do you think the market continues to trend in the direction that it went, or do you think that it all normalizes and just becomes random again?
In a 45-day time frame after the trade is made, I got to say it's all random. Immediately following, I would say it kind of stays in the direction it's in. I don't know if I'm answering. I don't know if I'm answering to the study.
Let's take a good hard look at this because it's really interesting, and some of the results are a little different than you might think. Publicly traded companies release quarterly earnings reports detailing their financial performance. These reports come out either before the market opens or after the market closes. The overnight moves accompanying these releases are often dramatic. Because this is anticipated, implied volatility is typically elevated just before earnings and falls off after. We've explored placing earnings trades before, but whether you have an earnings position still on or you're considering trading an underlying now that the dust is settled, what happens to the underlyings in the weeks following an earnings report? This is an important question for retail traders. Let's take a look. This is the first kind of study we've done exactly on like this topic. Next slide, please, John. So we examined each earnings announcement from the 15 largest components of the S&P 500 for the past 8 years. So it's a massive study. For each, we looked at the overnight's earnings move and the 7-day move, and then the 30-day move, close to close, following the earnings move. So we looked at overnight, 7-day, 30-day, all right?
All right,
a correlation from -1 to +1 between the size of the earnings moves and the size of the following moves. How frequently the following move was the same direction as the earnings move. We call that continuation. The average size of the 7 and 30-day moves, meaning the mean absolute. So we contrasted the overall statistics of those following earnings moves that did or did not exceed the implied move. And we just put a little caveat at the bottom, says, note that these earnings moves only stayed inside expected 48% of the time, far below theoretical or the empirical non-earnings frequencies.
Yeah. Okay.
Let's go to the next slide. So what comes after earnings? So the first one we looked at was overall, okay? So the correlation, the continuation, and the mean absolute move. So this is interesting because you know how sometimes we go, well, it's only got priced in a 3% move and stuff like this. And remember, this is the top 15 stocks over 8 years in the S&P 500. So when we look at the overall, the size correlation and the continuation, the first thing that pops up here is that, you know what, these moves tend to be a little greater than whatever the expectation is right around earnings, because those are higher numbers, the mean absolute move, and the continuation number is a little higher than a random number would be.
Yeah.
I mean, they're a little bit higher. So the size correlation is also interesting in saying that after 7 days, there's some correlation. After 30 days, there's a little less correlation, but the continuation of the move is pretty good. Let's go next slide. So on this slide, this is with earnings inside the expected move. Now, of course, if it's inside the expected move, the correlation is going to be lower and the continuation is going to be lower, okay? And then the mean absolute move after 7 days is obviously smaller and after 30 days is smaller. So when they're inside the expected move, I would say this is pretty random. 52%, you know, that's probably in line with just a completely random number. So if the earnings are inside the expected move, then there's not that much to actually consider, right? About a continuation or stuff like that.
Yeah, 100%.
Let's go to the next slide, John. This is earnings outside of the expected move. Well, here, everything changes. And you can look at the size correlation, you can look at the continuation numbers, and you can look at the size of the mean absolute move. And what happens for earnings moves outside of the expected move is that there tends to be a very high continuation move after the number comes out. So if you have a really bad earnings report, there tends to be, 8 out of 10 times the stock continues to go lower after 7 days, and 7 out of 10 times after 30 days. And this is in the top 15 stocks in the S&P 500. And if it's, and I think those numbers do have a lot of value to them.
Agreed. I think they do
and
too.
The mean absolute move is usually greater than you think it's going to be.
So it means you got to be a little bit aggressive, especially if you're looking to roll up the untested side or do anything like that. I mean, that's my takeaway.
Yeah, I think that's fair. Yeah. This is a very powerful slide that we haven't done before.
And it's funny because if I think back about emails that I get for earnings, if a stock moves, let's say, outside the expected move to the downside, even though the market's a little bit, bid the way it is right now at market highs. People sit for a couple of days because they think it's going to correlate with the market or come back a little bit. Most of the time, it is like, what do I do now? I didn't roll, that kind of thing. So I think being aggressive with your rolling is probably my biggest takeaway for this.
Okay.
Earnings.
Next slide, please. Those are bigger numbers than I thought, way bigger. I thought there'd be a little bit of positive, outlier moves would have a little bit of positive continuation, but not from 50-50 to 8 out of 10.
Right.
When earnings moves fell within the expectation, the underlying afterwards performed like the underlyings any other time. That's exactly that was our takeaway. The following unexpected large earning moves, however, we saw the underlyings making large moves very frequently continuing in the direction of earnings, like 70 to 80% of the time. These moves might well be anticipated and priced into the premiums available post-earnings, but understanding what is typical following earnings can help you choose how to play it. Yes, it definitely is going to influence and impact our decisions somewhat. So very good market measure, really good market measure.
Very nice, but you know what? I got to take a quick 90-second break and come back. We got Mr. Scott Sheridan. We're going to your phone calls, 855-238-2789 or 855-BE-TASTY. You got any questions? You give us a buzz, Mr. Sheridan, Mr. Sosnoff, and I will do my best not to butcher things. We'll be back in 90 seconds to Tasty Live.
Hello, everybody. We're back. I'm Tom Sosnoff, Dylan Radigan in the house. After a long night last night, Dylan, we are raring to go.
I mean, I know that there's not the point is that we have. I just one brief comment. Shocking, stunning, incredible. Not what I would have personally preferred. Not what I thought. Not what I would have predicted. But remarkable. Is all a remarkable outcome. I'm not going to bother trying to explain why the outcome was what it was, because there's a million people offering their 3 cents and it'll buy you nothing followed by nothing. So I won't give you too much of my thoughts, but I'm interested just on the occasion of the peaceful transfer of power, which is intrinsically better than the inability to transfer power, one, or the violent transfer of power, which what America does, even in its corrupted state, as far as I'm concerned, is superior to no transfer or violent transfer. But it brings up a question for me, which revolves around, because you look at the map and it's the entire Northeast uniform, right? Like on the upper Midwest, Illinois plus the Northeast plus the West Coast is like one world, one nation, one value, one filter, one value system. And people from Chicago work with people from New York and California. We know all these people. And then there's clearly a different sort of a filter, right? And again, it's a distorted filter because it's a 50-50, 51-49. It suggests not a bunch of people on both sides. And the blue states have a bunch of red and the red states have a bunch of blue. And if I could change one thing, I would eliminate blue and red states and just do proportional representation, but no one asked. So my question for you, sir, is do you believe there is, does there exist today, in your opinion and mine, I'll offer some opinion on this, and a set of shared values that unifies America as a vision for the nation? Clearly not, there's always a dispute about who the leader should be. That's a permanent state of every nation in the world. But relative to a collective mission statement, like if you were to go to this, if you were to say, what are the 3 most important things for America, to America? One, forgive me a little Star Trek reference, but Captain Kirk had first principles. The way that all the filter through which all decisions on the starship shall be seen, whether it's moral principles, financial principles, security principles, whatever. And so my question for you on the day after, as it were, is do you believe a set of first principles for the United States have ever existed? Going back to its founding, obviously there's sort of lots of glorification of we the people and all this. And are there first principles today? And what are they of the United States of America?
Have they ever existed? And the answer is yes, no question about it. But it was a smaller sample size, so it was a little easier and to define and less, less communication, less outside
lower
interest.
Velocity of everything.
Very slow, no velocity.
No cars, no information movement.
Yeah.
Postal system.
And over the years, that kind of mission statement has clearly, diminished. I mean, it comes back every once in a while. Like you'll get it after, probably after World War II, and after some difficult times. Let's say, I'm just trying to think of times in history. Maybe the Kennedy assassination.
The day after September 11th.
The day after September 11th was my next one. So you have, World War II, Kennedy, September 11th. To a certain extent, pandemic, but not really, but maybe a little bit. But you get these times and you get these events that kind of bring the country together, and there's a little bit of a shared vision, a shared message, a shared belief. But one of the brilliant pieces, whether it was intentional or not, of Trump's strategy, and it wasn't a Republican strategy because it didn't exist before him. So this is not a party strategy at all. I mean, absolutely not a party strategy. And mind you, I don't give Trump a lot of credit for being bright, because I think it's fair to say he's the dumbest president we've ever had, and he's the laziest and dumbest. So I don't give him too much credit for anything like that. But one brilliant byproduct or derivative of his campaign and his whole process was that he figured out, and I don't know if it was intentional at all, but he figured out how valuable decisiveness really was, and he pounced on it. And he pounced on the fact that there's not a shared message. And so he took advantage of it. So one of the things that the Democrats did really poorly, and one of the things that the Republicans have done really poorly throughout the last, let's call it, that I can remember, last 20, 30 years, 2, 3, maybe 4 decades, is that everybody believes that there is this shared vision. And so everybody goes out and starts to spread the message that, we're going to make things better. We're going to address A, B, C, and D. And we are
on the presumption that better is a shared concept.
A better is a shared concept. And everybody, we're all watching the same movie. We all ultimately think the same way. And therefore, we should all believe in this shared vision. And as a Democrat, I'm going to make that vision come true. And the Republicans would say, as a Republican, I'm going to make that vision. Our platform's a little different, but the shared vision is very similar. The shared beliefs are similar. Trump came along in 2016 and said, screw this. I'm going to change the narrative. And my message, Trump has never, ever articulated a single part of the platform, a single plan, a single strategy, a single idea, nothing. He's never been able to articulate one thing. But what he has been able to do is to create another message which goes counter to the traditional Republican and the traditional Democratic message, which is that there is this shared vision. He said, no, there's not a shared vision. There's basically my vision. And people bought into that. Some people bought into that. And it had virality to it. And then when he realized that it had virality to it, I think at first in 2016, it surprised him. By 2020, he believed it was unstoppable, but it got stopped. And then in 2024, he went back to the playbook and it worked. But his absolute belief that there is no shared vision is what won him the presidency this time around. And it's a very interesting strategy because it is truly a disruptive, non-traditional strategy that nobody has ever applied before. And it worked. And Kamala went with the traditional strategy and she fell flat on her face. And, you know, other Republicans in the past have gone with that approach and they've fallen flat on their face. And so, you know, so the answer is, it's very difficult to have a shared vision and actually make it work, although that has been the playbook throughout the years.
And so, yeah, I don't want to slice and dice too much of what you said.
No, I understand.
It makes sense. I'm interested. I'm just sort of absorbing it and I'm listening to it. So my perspective, and I'm not even going to get into this particular election, but I would say that there's basically 3 available visions for any country, with the United States being the one that's the most important to me personally, and the one that's the most relevant, I think, to everybody on Earth at this moment, and obviously the focus of the discussion. But it could in theory, these 3 visions could apply or do apply to every country: China, Italy, Brazil, whatever. One vision is our mission is prosperity. I, as your leader, will help. We will make money. And we will be prosperous because of my policies and because of my judgment and because of who I am. And then there's another vision that is, I will keep us secure. We will be safe and we will have power because of me. Right? Which is, I would say, was George W. Bush in 2004 is he beats Kerry and I'll keep us secure. I mean, I would say that's Putin's basic situation, right? I mean, not to mention obviously the rigging, but anyway, I won't get into the.
It's a strong man. It's a strong man position.
Security over security first, as opposed to prosperity first.
Yeah.
What I'm getting at is I feel like there's 3 basic available filters that are used by every leader. One is either prosperity first, 2 is security first, and 3 is morality first. Because we are good people, because we believe in the welfare of others and those less fortunate and all this. Every politician uses all 3, right? Prosperity, security, morality, as the base filter for everything that they do, directly or indirectly. My cynical perspective on the United States, which I'm vulnerable sometimes to a touch of a cynicism about the United States governmentally, is that the first priority, the first principle of the United States from its outset is prosperity. But that the political rhetoric sometimes drifts toward the appearance of morality. And that the reason Trump won, and the reason that George Bush Sr. lost, or the reason that Obama won coming out of the financial crisis, or the reason Jimmy Carter was tossed out, or the reason Reagan was celebrated, was because they were the best avatar for the perception of prosperity, without respect to morality. And then you have other presidents who lead as a morality first. In this case, I think Harris led from a morality first message or identity or existence, and Trump led from a prosperity first. And my interpretation of this election is that America is a prosperity, and to be more crude, a money first. Money is the most important thing in the United States when it comes to leadership.
I don't disagree with you, and I think that is the approach that Trump took, and it worked.
Do you think that the unifying principle of that America is a prosperity first nation?
Yeah.
Prosperity over morality as a general.
Except we don't generally use the word prosperity. We the positive way to look at it is prosperity. Like we talk about it all the time on Tasty. It's prosperity. We talk about it as opportunity. Some people will refer to it as prosperity. In the case of politics, trading, we talk about it as opportunity. I think Trump flipped it around and made it into a negative case. But either way, that's the argument. It turned it into the economy, and even though we have a booming economy, said the economy's horrible because you can't afford to buy a house, you can't afford to buy a car, you can't
inflation.
Inflation, whatever it is. So you could have a booming economy with the stock market at record highs. You can have virtually zero inflation. You can have virtually zero unemployment, and they can make the argument that and win that just because you have less money, even though you're spending a lot, you have less money. Then that's the argument. So yeah, I mean it was effective.
But would you, if I said to you the first principle, the highest priority of the United States is the economy over morality?
I don't like the term economy because I think that's prosperity.
Something that is prosperity.
Yeah, it's probably unfortunate, but that is the byproduct of a free market democracy.
The most crass way to say it, and I'm not trying to degrade it particularly, but is money is more important than people in the United States.
I think this was an election that to a certain extent validated that because you were able to put aside all the craziness and all the insanity and vote for who you thought gave you the best opportunity.
Regardless of the consequences for people or character or
regardless of the ethics and the morality. Exactly.
Yeah. But I agree. I think a lot of people, I think that would be not a hard consensus.
No, that's a fact. That's
so the question is, can I extrapolate that to be beyond this election? Like, is that the first principle of the United States of America, or is that just the variable from this election? I guess is the more interesting question for me. I don't. This election is going to be whatever it is. What is America? Is my question.
What's more interesting about it was that Trump was able to pull off that argument without any evidence or validation, and what's even worse is that the Democrats failed to challenge his position with any form of articulation and substance, and therefore let them get away with it. So the real failure, because you can only control the things that you can control. And in the case of the Democratic platform and Harris and Walz, they did a horrible job at destroying that argument that the Republicans and primarily Trump was making, that is not the case. They couldn't defend their record. And the record's incredibly strong. And yet Trump ripped it to pieces and was very effective at doing that. And so, and that's essentially the balance of the election. That's where the balance of the vote came. He did a better job of rejecting their position and their success than they did of proving their success. And because of that, they lost the election.
And they were effectively the incumbent, so they were the prosecutor of the. They had to run in the affirmative, and he was able to run in the dispositive, basically.
Yeah,
because he was the challenger.
Yeah, the Democrats made a huge mistake. First, they hid behind a decaying Biden in the sense early on, so that they hid him so that he wasn't exposed for all his deficiencies and all his kind of declining mental acuity. What happened in the process was he wasn't out there to defend his economy and his position and his successes, which were huge, but he couldn't defend them, and he couldn't talk about them, and he couldn't brag about them. And so what happened was, because of his failures to be able to do any of that stuff, just even articulate what they had done, Trump pounced on it and very effectively destroyed the argument. It didn't even give him a chance to make the argument, destroyed the argument. And when Harris stepped in, it was almost like she didn't own it, so she couldn't articulate it either, because she didn't own it. And so he continued to pounce on that and make it look like it was a failure. And that became essentially, that became the entire race. And in the end, those were the failures. That was the disaster.
But is that America? But is that also an accurate reflection that, here be another, again, I'll go.
That's no different than history in American it's a sad part of American politics, but I don't know if that's any worse than what happens anywhere else in the world, even in a parliamentary system or anywhere else. I don't know if it's any worse.
No, in comparison, America always comes out looking well, if only because every other government is horrible in many ways, or every other governing system has all these flaws. The case for America as a money-first nation state at its outset is that it was founded on slavery, which by definition says there's some people that are a financial asset, they are not people. It was a transaction that said, this is a financial resource, this is not a group of humans. So that would be and then you can go forward and say, I don't care about who's what or this is that. We're here to make money. That's America. And if you're and my lead and it doesn't care if it's healthcare to make money, education to make money, everything's to make money from the beginning. Money's more important than people. On the other hand, I have the only nation in the world defined by the fact that if you want to be here, you can become one of us. There is no other. You can't move to Italy and become Italian. You can't move to Brazil, become Brazilian. You can't move to China, become Chinese. You can move to America and become an American. And you have a government that, while all sorts of flawed and all sorts of bad history, is constantly, at the very least, aspiring to be more inclusive and more human. And I think America's challenge is an unreconciled competition between a vision of a country that is a money-first nation, money at all costs. America is a nation based on prioritizing opportunity and protection for money. Or America is a nation where human freedoms, health, prosperity is the priority. And I think all of us would like to believe both are true. It sort of like goes to, I was thinking about it through the lens of our conversation from a couple of weeks ago, where you were talking about, we were just debating about resources for old people, retiring people versus resources for young people. And of course, better to invest in the young if you're forced to make a choice. And then I was saying, well, why do we have to choose? Why can't we take care of the old grandma and the babies? Why do we have to? Why that's a false choice? Was the sort of the discussion we were having. I think this is another situation where it's money versus people, and then the question is that also a false choice? Can it be money and people? And then obviously I'm saying, well, look at the healthcare system. I mean, you can't have, you're going to charge this kind of much money for vital drugs, or if your financial resources are hugely influential on the quality of the healthcare you get, that's the best example, in my opinion, of money over people. And I get that Trump, for sure, I agree with your analysis, right? I get that all the things you're saying that Trump did effectively and that they didn't do effectively. But I'm additionally interested on what you think America is. Forget what because both of these politicians were flawed for a bunch of reasons, that are obvious to everybody who voted at the end of the day. What is the United States?
I mean, we are the ultimate. We're the poster child for capitalism. You know, we truly are. And,
does that mean money over people? But the capital. Okay, so I'll let you speak. Sorry.
Yeah, I mean, it sounds a little sad, but it does mean money first. I mean, we are literally the poster child. We're such a melting pot of different types of people and personalities and languages and religions and cultures that, you know, and we're also a society where, you know, where you probably, we're probably the closest thing to, the American dream is probably the closest thing to kind of what you're describing. Just the availability of the American dream. I don't think it exists anywhere else in the world. And so, yeah, I do think that money is the motivator and money rules. And that I think in this particular election, there were a lot of people that were way too smart to believe half of the garbage, that half of the rhetoric, half of the garbage, half of the bullshit. Like I said, there was never once an intelligent discussion about anything, about any policy.
That's for sure.
No. We're not talking. These candidates have been on the road now for a year, basically, whatever, 9 months. There has not been a single detailed discussion about policy, about anything intelligent. There has been no intellectual discussion whatsoever on anything. Yet, they were able to create a narrative and about money with nothing to support it and win with that. And so I think that that validates your whole case for, you know, kind of for what happened.
But if America is a money first nation, then the person who's going to win most of the political contests will be the person that's the best at creating the perception that they're better for money.
People were able
Jimmy Carter lost because Ronald Reagan was perceived to be better for money.
Yes.
Barack Obama won because he was perceived to be better than John McCain for money coming out of the financial crisis. I can give a bajillion examples like this. And Trump won yesterday or today, I guess it is, because he was perceived to be better for money. And the people that were running against Reagan or against Obama or against Trump were saying, well, he may be better for money, but he's worse for people. The Mexican Wall, the
funny thing about it is he's not better for money. He's you know.
No, I'm not. Of course not. Obviously not. He's not better for anything in an irrational world.
Right.
I'm
so it's not
about
it's just
but
a
I'm
story.
saying it's a reflection of the United States because the United States votes based on what it perceives to be good for money, but more than anything, and because in this instance, Trump did a better job creating the perception that he was better for money. Has nothing to do with who was actually better for money.
Yeah.
Barack Obama may not have been better for money. Ronald Reagan, I mean, you can go down the list of who knows what at the end of the day what these people actually do.
No. Trump did a better job. Trump did a better job of selling that he's a better salesperson, and he sold everybody that voted for him that he's better with money. And you can talk about bankruptcies, you could talk about failures, you can talk about just pure business stupidity and all the idiotic things, and you can talk about the criminality, but it doesn't matter because he had the unique ability to convince people to accept his failures and look past that because they believed that he was better for them personally, that his policies were better for them, so that you were able to look past all the insanity, all the craziness, and say, you know what, in the end, he's better for me, which basically means, to me, means you sell your soul.
But that's also why they picked Reagan over Carter. That's also why they picked Obama over Romney.
Yeah, I mean,
over McCain.
I mean, if I thought about things that way, given where I am in my life, you know, with what I have and everything, I could look at the, you know, lower taxes for me, for sure. You know, lower capital gains, lower income taxes, you know, just lower business taxes.
Both your personal resources and your business resources benefit from.
I would have said, how could I not vote for Trump? You know, like how could I not support him? Because for me personally, his policies will benefit me. They're not going to benefit society. They're not going to benefit everybody. They're not going to benefit anybody that's been marginalized in any way. Okay. They're not going to benefit anybody who's the backbone of this, the foundation of our country. But for me personally, yes, it would benefit me, but I would not vote for that. That's not how I think. But there's enough people that do think that way.
That's money over people, right?
I know, but there's a lot of people that think that way.
Yeah. I mean, I think that is the prevailing sentiment.
Yeah.
Money is more important. Money is more important than people.
Yeah. Yeah, that's what happened.
Full stop.
That's what happened. So then you've answered your original question.
Right. So you know, the first principle is money over people is the first principle of the United States.
Yeah, and you know it usually happens.
Well, that would even be my money over people I don't know. To be clear.
Yeah.
Right. It's not over my wife, my daughter, my husband, my son, my mom. No.
Yeah.
But it's my money over people I don't know.
Yeah. Yeah. And so you end up in a situation, you know, I mean, where else would we elect the president who stole from his own charity? You know, like, you know, I mean, it's insane. But again, he benefits the most people and and a certain type of people, and the
people that are at risk, they don't know.
Yeah. There you go. And even certain people that have been marginalized, you know, bought into he provides a better opportunity at the American dream, which will allow me to make that money and give me my opportunity. And I don't know, you know, like, I mean, time will tell. History is not generally very kind to this personality. Like, it doesn't end well, but we'll see. You know, who knows? I mean, here's the thing. I told this morning to like Scott, because we were talking. I'm a positive drift guy. Like, I'm already put this behind me. Like, I'm done. Like,
you and me both. I'm so happy.
Yeah,
actually,
I'm done.
I'm thrilled.
I just didn't want this thing to carry on for
a million pounds off my back.
I didn't want this thing to carry on for 3 more months. I don't want any of the bullshit. Now you've got the House, the Senate, the executive branch. Okay, now shut up and get it done. Okay, a lot of talk. No more crap about how everybody's, you know, blocking you and you got this and that and, you know, you can't do anything and, you know, you're getting impeached. You know, I'm sure, of course, he's going to be impeached a couple of times, but who cares? You got everything you want. Okay, you got your $100 billion. You got all your crap. Okay, I don't want to hear the bullshit anymore.
Elon.
Yeah. Now, get your lazy butt and get something done because you've been talking smack. Now go get it done. The pressure's on you now, and I'm already moved on. I'm done. So I think that 4 years from now, everybody is going to be better off, regardless who is president. If it was Harris or if it's Trump, 4 years from now, everybody's going to be, I shouldn't say everybody, the majority of people are going to be better off no matter what. You can't screw that up. That's the beauty of what we've built. That's the beauty of our democracy, of how capitalism works in this country. And 4 years from now, 85 or 90% of the people are going to be better off than they are today, period. And 4 years from then, whoever wins next time, they'll be better off. So we have to look at this thing in a positive light and say, okay, you wanted it, you got it, go do it.
I find it liberating and delightful.
Yeah. There's a certain...
I can go to a 0% attention on this entire topic.
Yeah, because you don't have to spend the next 4 years. You don't have to spend the next 4 years defending somebody. You have that complete opposite side now. You don't have to say, oh, You know, like, no, this person really has done a great job. No, the economy really is good.
You've intended to do this.
Right. No, you don't have to do anything anymore. All the pressure's off you. Now you're done. You just get to sit back.
White's problem.
Sit back, relax, and watch the game play out. And, you know, and think about things in a positive fashion and enjoy the opportunities that are ahead. And don't worry about it. The political side to it's all crap anyway. I'm so sick of the rhetoric. Just get done with. Let's move on. Let's face the next chapter.
Teleportation, baby. On to the teleportation. I'm ready for teleportation.
No, and let's start focusing on real interesting, smart people for the future.
Yes.
That bring us a completely different perspective, level of intelligence, everything else. Let's go completely different. Full circle.
Different way to use time, a different way to use attention, a different way to use. I mean, I was listening. My favorite interview last night and watching the election special was the Cauchy kid. I shouldn't call him a kid, but the Cauchy boss who
is a kid
built this incredible.
Yeah.
And so, and I think that, you know, and you've been one of the greatest, I think, speakers on this topic or philosophers, sort of public. You've introduced the idea to public discussion more than anyone I know. That, you know, we can talk all the things about velocity and gamma and the rate of change being the highest it's ever been in communication and financial, and from no idea to a huge idea in a weekend and whatever, all the velocity stuff that flies around right now or that exists in the modern world / economy. And by definition, over the next 4 years and every day for the next 4 years, let alone the next 5, 10 years, 20 years, we will bear witness to the newest and most marvelous things that we've ever seen. And things that have never existed before will exist in a way. You know, think about how long it took to go from the horse to the car. I mean, I won't go through a bunch of historical garbage, but we will see a complete elimination and we'll see technological replacement and new things, the likes of which we can't even imagine. And I think that's going to be. I'm thrilled. I'm excited for it.
You know, the Tariq, the kid from Cauchy, I met him a couple of years ago, and I didn't know him from anything. And he sent me an email one day, and he said, "I watch Tasty Trade."
Okay.
I watched Tasty. At the time, we were Tasty Trade, Tasty Live, maybe, I don't remember. But anyway, because I watch your show all the time. And he goes, you know, I started this exchange. He gives me his whole background because I didn't know who he was. You know, I started this exchange, event-based. You might have heard of me. And I had heard of him, but I didn't know anything about him. And he goes, I would love to steal 30 minutes of your time and just talk to you about business. And I'm like, sure, of course. I love having those conversations. And he had raised some capital, you know, maybe like $25 million or something. He was building this exchange. And I had also been talking to the Predictive CEO for a couple of years about event-based and exchange, you know, event-based and election trading. And when I'm talking to the Cauchy CEO about the regulatory limitations to betting on elections, he said to me something to the effect of, "Oh, I'm gonna go after the CFTC." Now, you take somebody like, you know, me and all, you know, Scott and JJ and all of us here who have been fighting the regulators for, you know,
decades,
4 decades, where I'm like, dude, it is not easy. He goes, it's not easy for you because, and I remember this conversation, and he said to me, he goes, it's not easy for you because you've been doing this for decades. He goes, I don't know any better. And he goes, in my mind, I can take these guys. I have a valid argument, and I don't know that I can't win. And I'm like, listen, I'm so rooting for you, okay? That go get them. You know, you go do it because you don't know that you can't pull this off. Like, you really don't know. And he's like, you know, I forgot the exact words he used, but he kind of said something like, you know, I believe in what I'm doing. I'm smarter than I think I'm smarter than they are, at least within this subject matter. and
on this topic,
and I think I'm going to win. And I don't care if it takes 1 year, 2 years. I think it took 3 years, but he was right. And I've always really liked him. And we've met, you know, a bunch of times and gone out to dinner and had drinks and whatever, and just talked about, you know, the business. And we're not invested with them. We've never done anything with them. Just, you know, but I've always been impressed with the idea that, hey, you know what? Why not me? You know, why can't I do it? And I thought it was funny because he got a lot of his inspiration from watching Tasty, which was wild.
Yeah, and I just thought that of everything that I saw was the thing that was the best sort of dipstick or sneak peek for the future of creativity and possibility in the world, having nothing to do with political outcomes.
Yeah, and you know, it's one of the reasons that we're building another exchange now, because I really believe that we have, you know, some of the coolest ideas that have for listed exchanges that have ever been, you know, that anybody's ever come up with before. So we'll see if that actually plays out or not. But I guess, yeah. Anyway, doesn't matter. I don't want to change the topic.
No, but the world is full of possibilities. I think that you know that you can't. Politics is money versus people, but where we are in this passage of time for humans on Earth is at a historically spectacular moment in terms of creative possibility, and what a thrill to be healthy and alive at that moment.
He's Dylan Radigan. I'm Tom Sosnoff. This is Truth or Skepticism. Good stuff today, Dylan, and thanks for last night.
Thank you, Tom. Yeah, no, it's my pleasure. Thanks for having me.
Thanks, everybody.
S&P 6K, take out your hats, folks. It's Thursday, November 7th, 2024. This is Overtime. I'm your host, Chris Vecchio in New York, Ilya Spivak in San Francisco, Dylan Radigan in Milan to finish up this half an hour because it's Thursday. We do the abridged version of Overtime on Thursdays to make room for the prediction trade, where we will be doing a post-election recap show, and we'll talk about our friend Jeff's very successful night trading in those prediction markets. But before we get there, of course, we need to talk to you about what happened here in these markets. Join us on tastylive.com. Tell us what you're trading in the YouTube chat. Tell us if you think this rally is going to keep going. We can go to the charts right away, guys. S&P 500 up at 6,003.75, another 0.76% on the board for the good guys. The Federal Reserve meets today. They cut rates, and Powell tells us maybe we should think about when the cut cycle ends. Quite frankly, that may be good news for the bond market because bonds are up after that. Why? It means the Fed isn't driving drunk at the wheel. They see what the bond market's been saying since the September meeting. The Fed isn't going to over loosen. Everything is okay. So you have a NASDAQ up by 1.6%, a Russell that takes a small step back, changing leadership positions with tech, down by 0.28%. Bonds up across the curve, gold, silver are higher. Chinese stimulus overnight from the PBOC sends copper rocketing, the Australian dollar rocketing, the dollar's down everywhere. It's kind of just a big risk-on sort of session, Ilya. The NASDAQ here now sitting up at that hallowed July high, not quite through there on a closing basis, but we did test it and punch through it, if ever so briefly, today.
Yeah, it's an interesting sort of day here. I don't know if I would attribute very much to the PBOC's actions. The real question in China at this point is the National People's Congress, where we're looking for a substantive fiscal announcement. But the story, nevertheless, is relatively risk on pretty much across the board. It's an interesting thing because the sort of makings of these moves is a departure from what we saw yesterday everywhere but for stocks. The dollar was up a lot yesterday. It's retraced about 50% of it here against the major counterparts on average. The situation in bond yields similar. And the bonds themselves, obviously, massive rise in yields yesterday, today, backing up a little bit. So we're looking at a situation here, I think, that looks corrective after what was a massive post-election readjustment everywhere, really, but what's going on in stocks where we've gone from strength to strength.
Strength to strength. Dylan, we are done with the election. Volatility is coming down across the curve. It does not look like it's going to be contested by any stretch of the imagination. It looks like a red wave, even if we're still counting votes in California, which will take some time. Nevertheless, the market is positioned right now for, I guess, back to what we were doing, right? I mean, we're worried about AI. We're thinking about the GLP-1 drugs. We're thinking about an economy that has a 4.1% unemployment rate at the macro level. Again, I know individually on the micro level, we talk about grocery prices and it sucks for people. All of us buy food, we understand. But macro level stuff that financial markets pay attention to, it's still good. So, Dylan, why should we interpret the price action in the NASDAQ today as anything other than the unclenching of what has been several months of consolidation fear leading into the election?
No, I mean, I think I don't think you should. I think that not only is the Trump victory seen as incredibly favorable to financial markets, but a resounding victory for either candidate, which is not what we had in 2016. We basically haven't had a president-elect or a presidential victory that is so clarifying since Obama won in 2008. And regardless of whether it is any individual's preferred outcome, including my own, it's incredibly valuable to have clarity. And it's even more valuable if it's clarity in favor of lower taxes, lower regulation, and the knee jerk, and that it basically, until Trump in some lunatic fashion F's it up through some bizarre action of which he's more capable than anybody who's ever been in charge of America. But until he does that, it's the best thing that's happened to the stock market since 2008 in terms of clarity and conviction. Everybody focuses on policy. I think that the clarity is more valuable than the policy. It's unambiguous where the leadership is. It's unambiguous where the policy parameters are. And in this particular instance, the leadership and the policies are super favorable in the short term anyway for financial markets. And to try to dispute that, either in rhetorically, let alone financially, is preposterous. I mean, obviously, going to Tom's point earlier, the temptation to entertain some sort of short-term trading pullback has logic, and obviously there's going to be some moment in the days or weeks ahead where there'll be some reversal for whatever reason. But at the moment, you're either long and happy, which most of us are, even if maybe I'm not long stocks in my trading account, but I'm long stocks in my investment accounts, so I'm not complaining. I certainly have no reason to be short. I would say the more courageous position, which I lack the courage to take, but it may well be the right one, will be actually to originate long positions now, because we may look at this 2 months from now and be like, oh, you should have bought that response, that signal the 2 days after the election was foreshadowing the best year-end rally in history, which that's not an unreasonable outcome for the next 60 days.
I actually completely agree with that assessment completely. I am long stocks in the way that Dylan describes, in investment accounts that I'm not tactically trading in and out of on a 45-day type of cycle.
Sure.
And I think the case to continue doing that is remarkably compelling, especially if we continue to see the kind of disparity in growth outcomes. The U.S. economy is booming. Everywhere else is in deep trouble. And to the conversation that Chris and I had offline before the show, I think we agree that means more capital is coming here because the returns are going to be here. And if we're going to have a more protectionist, more isolationist policy going forward, as looks likely, we are then going to see the disparity persist, and before it ultimately blows back on the U.S. will be quite some time. So it's the kind of thing that very much favors the dollar, very much favors U.S. equities as a broader and U.S.-based assets in general as kind of a broader theme, probably for the forecastable future. Mm-hmm. But as a trading sort of tactical next several weeks kind of thing, what gives me pause is really where the NASDAQ is and where it is relative to what the news isn't going to be over the next 24 hours, because there's not much there. And that takes us right into the weekend. We've had a massive run. We're directly at resistance. The NASDAQ was the leader in this rally the entire way forward until July. So, and obviously, I think with the Fed policy announcement, we've had something of a reset on everything that's happened in the Fed narrative since July. So it's a very auspicious place to be. So now I think we get into a space where if Monday might be the time to buy in, you could have an opportunity to buy in perhaps at better levels then than you can now.
It might be a short-term pullback area. Similar to, I guess, the trade mechanics here of working through repositioning is a worthwhile discussion quickly before we talk about the sector balance. Similar to what was done in gold a few weeks ago at the end of October, where once, even if you have enough time on your side still, if you bump into your long strike, it's worth rolling out to buy yourself some more time. And so if the last several days I was playing, it's at 20,000 and I think the stock market's going to go up after the election. So I'm buying, I'm structuring a long delta trade such that I need it to go back to the July high within the next, say, 30 to 45 day window. We just got there in 3 trading sessions. Okay. So if I'm, say, at 25 or 30 days to expiration right now, and we're sitting at the point where my long strike is, and I think this market's still going up, what should I do? This is actually a really good place to roll out. Give yourself some duration so that if there is a short-term pullback, you're not stuck in a position that's moved against you and all of a sudden you kind of lose the confidence to keep it going because this was a bigger winner. Now it's a loser. Technically speaking, we see that 1 week moving average is beginning to pull up through that October 30th high. And if we do have any sort of pullback here in the stock market, as long as 20,750 or so holds in NQ, then you're probably still on strong footing. And likewise for ES Z4, at least still a tradable contract. If we hold above that mid to late October high, 59.27 and a quarter, it's a mechanical type of marker right now. But the reason why I'm so confident technically is if this is the inverse head and shoulders pattern that I think it is, the fact that we have the neckline resistance, support, and then we swing through, the initial measured move is roughly speaking 200 points of what we just saw in this multi-week consolidation. So 200 points on top of 59.30 gets you to 61.30 as your immediate term target here in the S&P 500. And then the longer term inverse head and shoulders pattern that we've been trading up, and that's why we're in the ESH5 contract, that calls for 6,300. So the only thing that I might be doing here in stocks, I don't like to rock the boat if there's no reason to rock the boat. I'm very much a person who likes to, like today, I had my positions on, they're all working. So I spent a good day of time reading The Ascent of Money so that we'd have some content to talk about, right? Because we're now out of election season and we need new things. So let's talk about financial history a little bit as some of the topics here. I'm trying to.
Oh, my favorite.
Do I make adjustments now? Because I'm long the 6,000 here on the follow page. There's 54 days to expiration. I'm short the 6,200. So this is clearly working. There's clearly a lot of time left here. I don't think in this case I would, because there's 54 days left. But if today was 21 days to expiration or tomorrow was 21 days to expiration, Or you know what? If even next week, next Friday was 21 days to expiration, I would absolutely be using today to roll the position out and recenter my strikes. Well, not recenter, push out my strikes further such that I can get back to the position squared for like a 25 to 30% probability of profit. Why? Because given the scope and scale, if people were trading on the long side with me in the middle of September for this particular position, you're now at a point where you can structure the trade so that if the next leg in this breakout momentum chain that turns against you, the loser will be about half the size or less than the previous winner. So when you're trading up in these momentum breakout markets, when you start to get to your long out of the money strike, it's worth then rolling out in time, and it's worth giving yourself a position such that your loser won't subsume the previous winner. And even if that's the last trade that worked out, you know what? You may have only been 50-50 right, wrong, but you still walk away profitable net between the two. I'm not there because I have 54 days. But if I was closer to expiry, I would absolutely be using the day where we breach the strikes to get myself more time in the event that there is a little bit of a short-term pullback here. Why might there not be a pullback? Because the sector rotation kind of speaks for itself right now. There's a lot of capital flowing into consumer cyclicals, which we've previously pointed out is a sign of leadership and strength in the market. You're seeing it in industrials and XLI. Take a small step back today, but we did hit a new all-time closing high yesterday as well. You can go over to the banks, which again, a little bit of softness coming in today, but yesterday we push up to a new all-time high in XLF. So banks are up net this week. We have industrials up net this week. We have consumer cyclicals up, and that PEZ removes the outsized weighting of Tesla, which if you want to look at XLY, which has a large Tesla component, this too is surging. It's these asset allocation decisions that show you where people expect the economy to be going over the next 6 to 12 months. If I'm buying XLY or PEZ today, it's because I think that there will be economic activity to generate the corporate earnings to substantiate the valuations and the earning expectations that are attached to these stock prices right now. And these are the type of sectors that outperform when? In the early to middle stages of a bull market. I can't look at the factor performance here and think that we are anywhere close to anything other than a short-term top. It is fundamentally a very strong market, regardless of who's president. It's still a 4.1% unemployment rate. It's still a 2.5% inflation rate or so. It's still an economy that's growing around 2.5 to 3% in real terms. The semis, though, today, guys, to get off my soapbox here, they are among the leadership groups. SMH up 2.44%, NVIDIA here, closing at its highs. After hours, it is moving higher. It is at a new all-time high. Dylan, this should be the story. This is the super glide. We're fine. Everything's fine. So if everything's fine, what are we really worried about? What are the risks abroad that we're not considering right now that dumb bulls like me who are dancing on bears' graves today, what am I blind to at these levels?
There's only really two things. One would just be valuation, inflated, euphoric valuations, too high of a price of money today for the discounted value of money tomorrow. That's your number one risk. And your number two risk is unwelcome data regarding either inflation or weaker labor markets, which, by the way, you have weaker labor market data, which was generally ignored the Friday before the election. All the numbers were revised lower, et cetera, et cetera. And so a weakening labor market is something that exists right now. And so a weakening labor market is a cousin of inflation, one way or the other. At least it's it's the rock and the hard place around which the central banks get trapped is labor and inflation data. And so that's your one risk is the matrix of labor and inflation data. And the other risk is you're paying too much for, as any trader or acquirer of assets, even long-term, any person who does such things, order entry, the price of order entry is effectively the destiny of the trade. So if you pay too much to get in, even if you are right, it still may not be something that is profitable. And if you pay too little for a lousy asset, that lousy asset, as a result of time and positive drift, may turn out okay. My favorite Sumner Redstone quote from decades ago at this point, but Sumner was in his heyday one of the great sort of extrovert CEO deal makers on Wall Street in decades past, as you reference Wall Street history. But he was always famous for saying the deal from hell became the hell of a deal. And the way the deal from hell becomes a hell of a deal is on the cost of acquisition. And right now, acquiring stocks, certainly NVIDIA or whatever, it's a function of valuation. The super glide is real. It is happening. Even the biggest skeptics among us do not dispute that. The only dispute is the present value of the future cash flows of the super glide, which is unknowable and easily miscalculated. And that's where your risk lies. But I would say the one you're not looking at will be a weak labor market. The sleeper here is that the lousy November jobs number, the lower revision of the October jobs number, the lower revision of the September jobs number leads to a lousy December jobs number and a lousy January jobs number. And now you got a new president coming in, and it's a different situation. Obviously, the odds of that are relatively low. I mean, I think that the base case is this market goes crazy right through the inauguration, but for some pullbacks. But to answer your question, it's the labor market and valuation are the two risks that you personally sit upon right now as a lunatic poll emergency responder / bull market, caballero, a cowboy of the bull.
All right, it's time to come clean about this. I was actually selling my kidneys so I could buy more 0DTES
don't
gold.
lie about it.
So
don't lie about it.
I could show you the scar if you want to see.
You were in the Toyota, flashing the lights,
running red
lights.
You know what really bothers me about our
to
tariffs?
Get back to the polls in time for the emergency before God knows what happens. And then look, you blew it anyway. She lost.
How is Toyota? Like, what do you think they feel when they look around the world and like, oh yeah, there was another terrorist attack, and they show like the B-roll news footage, and it's like some guys driving around in like Toyota pickup trucks?
Pride.
It's AKs and Toyota pickups all the time.
Pride.
We're not allowed to import those kind of pickup trucks into this country though, which is a real bummer because, they seem to be pretty durable and they last a long time.
I've generally, through as much of my life as I've had the privilege of the opportunity, had a 2-car garage, and one of those cars is always a Toyota 4Runner, because that
my first car.
If a terrorist is going to, it is the most reliable car on earth is the Toyota. If you don't have a Toyota, God knows what'll happen.
My first car was a 99 4Runner, and I got it up to 180,000 miles before one of the gaskets popped and filled the car.
I can see you in. I had a 96 4Runner for 20 years until 2006. Ran it to $250,000. That's my best car I've ever had. Anyway, I can picture you in a 4Runner on election night just 2 days ago, flashing your headlights.
Okay, so we only have 3 minutes here.
Blasting through the intersections of Bedford, New York.
Intersections? We don't have stop signs out here. It's all dirt roads. Dirt roads to where? For XRT, it might be a road to 90. Guys, XRT is not one of those ETFs that's skewed by large holdings. XLY, its two biggest components are Amazon and Tesla. XRT is retail. And the studies show, as we've discussed in the past, if you're bearish on the economy, XRT is probably the best place to look, because during previous economic pullbacks, XRT has produced the biggest losses. It was the biggest loser throughout the recession, for example, among the sector ETFs here that we like to track as it pertains to consumers. So when I look at XRT and it's sitting at the top of a multi-month range that has been just chopping, and I look to see the distribution of holdings, and its top holding is Carvana at 1.63%. The second biggest is Bath and Body Works at 1.56%. And then Warby Parker, GameStop, Victoria's Secret, Boot Barn, Sprouts Farmers. This is the kind of crap that people buy with disposable income. If it's breaking out here and we have an economy that we know, because we look at the macro data, is pretty strong at the macro level, this is a measured move that calls for this collection of assets to move up to 90. So tomorrow...
This is a pocket of the market that I'm actually very interested in being long. Because we have seen the highest split in spending on services relative to goods in 20 years. 20 years.
With Trump's going to get worse.
And it might get worse.
We're not going to buy stuff from abroad.
We've seen goods underperform significantly. So yeah. I'm watching what happens at the top of this range very closely, because on one hand, it's tempting to say that there's a reversion to the mean that's called for here, where we do more spending on goods relative to services. But if massive tariffs are coming, that's not what's in the cards.
Dylan, there might be a madman trade in here. 43 days doesn't seem like enough time. But if we were to go all the way out to, say, 71, I'd really like to do 134, but that's not. We could buy... Maybe these prices aren't correct after hours, but we can buy the $85 call in a measured target in XRT that goes up to 90. That is trading at a very robust $1.50 right now. So if you're willing to risk $150 for a potential $10, or you're willing to risk $1.50 for a potential $10 move in XRT, if you believe in the economy, if you think people are still spending money, if you're like me who thinks that the tariffs are coming, they're going to be terrible, but it's going to mean money circulates internally as opposed to going abroad. So services and little knickknacks, makeup, jewelry, stuff for your car, this, that, if it's produced here at home, that is going to see an increase moving forward. XRT is the place to look for that. Guys, we are done here for this Thursday. We're out of time and overtime on a day when the S&P and the NASDAQ close up at all-time highs. We should have that soundboard for the round of applause, but we don't, so a little round of a golf clap. We'll be back next Monday, as we are every Monday through Thursday here for overtime right after last call, 4 p.m. Eastern, 3 Central. Of course, today is abridged because we are going to the prediction trade after this. We have to talk the election.
There it is. There.
We have to talk the election results, so make sure that you stick around. But for my friend and colleague, Ilya Spivak and Dylan Radigan, I've been Chris Vecchio. See you soon on the other side of this break. And make sure you stick around for Macro Money at the top of the hour.
See you there, folks. We have another up day in stocks, even as the dollar and bonds take a breath to think about things in the wake of the huge reaction that we got in the financial markets following the result of the U.S. presidential election. And arguably, because that result came quickly and was not drawn out, we have missed a bit of something, though. We're not alone. It seems like the market was so focused on what was going to happen in that election that they weren't really paying attention to economic data coming out of China that might be signaling something of a sea change in the works. That's what we're going to focus on here on Macro Money. I'm Ilya Spivak, head of Global Macro here at Tasty Live. We're going to break down what you might have missed about economic developments in the world's second largest economy over the past couple of days, how that might impact things going forward, and in fact, how it is already impacting them, but also the trading opportunity that might be taking shape as these headlines come across the wires and the markets respond to them. So let's first take a look at what we've seen here overnight. This is ASHR. It's an ETF that's tracking China's benchmark CSI 300 index. It is essentially China's version of the S&P 500. This is going to track the biggest listings both on the exchange in Shenzhen and in Shanghai. And you can see here, a potent rise in those markets over the past day, which is an interesting thing to consider because, of course, the expectation might be that the exact opposite should be going on. We've just had Donald Trump win a resounding victory in the U.S. presidential election. Both candidates were China hawks, as it were. Both of them favored a more assertive stance, certainly not a loosening one. And the resounding victory for Mr. Trump seems to suggest that voters very clearly wanted the more muscular, the more assertive, the more combative version of the China hawk stance of the two candidates. So it seems a bit strange, perhaps at face value, that you have this very strong rise in Chinese stocks, even as the candidate that's going to take up residence in the White House next year promises more of a trade war footing, promises more tariffs and promises to single out China for higher tariffs than elsewhere. Nevertheless, the ASHR here surging as the underlying index posts a rise of 3%. That's the biggest increase it has seen in essentially 2 weeks' time. 3 weeks' time. October 18th was the last time anything comparable occurred. So we're looking here at significant optimism, confirmed as well in copper, a sort of famously sensitive commodity to China's business cycle. China, of course, the world's largest buyer of copper. And so if there were, in fact, some sort of a positive development for China's business cycle, then perhaps you would expect both stocks and copper to move. But because Chinese stocks can often be inspired by decree from Beijing, that you see confirmation of their move in what is a broadly traded, liquid, open on the markets commodity, that gives credence that the move isn't just a flash in the pan or an official's dictum, but rather something that reflects genuine market optimism about what's going on. So why is it that we have this kind of a thing? And the answer seems very clearly economic green shoots. This is the import-export data that came out of China this week. And what we see here is very clearly a strong pickup in exports. You see that right here. Imports, of course, continue to be anemic, so domestic demand not exactly sending the best of signals, but also not really deviating from the range where it has sat for the past several months. And really the range that's been carved out here since the beginning of the year, we're just about within that coil. But exports here clearly booming. As a matter of fact, we saw a rise of over 12% in exports here. That amounted to the biggest year-on-year increase since July of 2022. So needless to say, a very strong sort of picture here for Chinese exports that speaks to exactly the kind of demand that the beleaguered economy might hope to see were it to begin to recover from its long malaise after it lifted zero COVID restrictions belatedly and really has struggled to find its footing ever since. Just a mere day earlier, we got a slight hint at essentially the same story from the Caixin and S&P Global Purchasing Manager Index data. Now, there's an interesting thing in China where you get, much like the US, the domestically formed version of this data, and then the S&P Global version. S&P Global tends to be the main provider of PMI data for most economies, but some of them do their own or have a rival set. In the U.S., we have the S&P Global numbers as well as those from the Institute of Supply Management. In China, we have official numbers from the China Federation for Logistics and Purchasing, CFLP, and then we have these numbers, which are from S&P Global, the main international provider, in conjunction with Caixin, which is a media company. And what we see here is a very interesting pickup in both manufacturing and services. Now, manufacturing still basically at standstill. The way these numbers work is they have a center axis at 50, where that's neutral. That's neither growth nor expansion, or growth nor contraction, rather, of economic activity in the relevant sector, services or manufacturing. And what you see here is that manufacturing then is hugging that 50 line. So having decelerated here from about May, it is essentially holding a little bit above, a little bit below 50, depending on where you look in recent months, and is essentially hovering at no movement, at standstill. Services, on the other hand, post a very strong rise here. And what this boils down to as a composite number is the strongest pace of economic activity growth in China in 4 months. Now, where we find a bit of confirmation for the export side of the story here, or at least the driving emphasis on that as the reason why things in China are doing what they're doing, if we turn to that report, we see it cites another solid rise in export orders and sort of cheekily hints that this speaks to rising interest from foreign markets such as the US. Now, one might wonder how it is that we have a pickup in economic activity and a surge in exports, ostensibly because of a rise in interest in foreign demand, notably the US, when the US is at the forefront of a trade war that looks likely to escalate now that the relatively softer version of it under the Biden administration, which would be probably continued were we to have a President Harris next, is likely to transform into the more combative version, which we saw obviously begin in 2016 under the prior Trump administration, and that, by all accounts, has every reason to return, listening to the president-elect himself, in the second administration. What's more interesting still is that official figures out of China for the same period for October are not nearly as rosy. They're actually at standstill. As we can see, both official PMI and service sector, the service sector activity index are essentially at the 50 level. So they're basically stuck and have basically gotten here since this reopening post-COVID. So the zero COVID restrictions come away right here. We can see there's a surge in services activity, manufacturing perks up. It lasts for a grand total of between 2 and 3 months, depending on whether you look at manufacturing or services. And then things turn sour and they never come back. We get down into standstill and sit there. Now, the frequent refrain is that Chinese economic data is massaged in order to look better than it is. This is the opposite story. These are the official numbers, which tell a more dire, a more anemic story than do these Caixin ones, which tell us that things are actually getting a little bit perkier here. So is this then a reason to celebrate? Well, the market certainly seemed to think so, looking at their initial reaction, but does that make sense? Perhaps not. Perhaps the focus on exports here is the tell. If the markets know, and if businesses know that the tariff environment, the tariff status quo, is about to become much more restrictive, that trade barriers are about to rise much more emphatically, then you would expect that businesses would try to front run that. They would expect higher costs downwind, because of course it is importers of Chinese goods that pay tariffs, not China. One government can't exactly compel another to pay it a tax, but it can certainly compel its own domestic companies importing Chinese goods to pay a tax in order to import it, which is, of course, exactly how tariffs work. So companies, for example, in the US that foresee downwind higher tariffs and a generally more combative trading environment with China would be well served to buy as much and to build as big of an inventory of Chinese goods now as they can before those costs go up. So the pickup in export growth here doesn't actually tell a story of resounding strength, does not tell a story of returning demand that can be extrapolated further, but rather seems to be more about front running before things transition into much darker times. That is, if you're an importer of Chinese goods or an exporter in China feeding that demand. That, of course, does not bode well for the general anemic state of China's economy, where now for 6 consecutive quarters, there is economy-wide deflation. We see here in the red is real GDP, in the yellow is nominal GDP, which is supposed to be the rate of economic output creation, as it were, including inflation. Real GDP is supposed to strip the inflation component out and get to just the output. Well, if the real one is above the nominal one, that means that what we're doing when we're subtracting inflation from nominal growth is we're subtracting a negative number, which means inflation here is negative. And at the GDP level, this speaks to economy-wide deflation to the tune of nearly a percentage point of GDP growth on average over the past 6 quarters. And so what we're looking then at when we consider these numbers is, just in very simple terms, an economy without demand. The price for things goes up when there is demand because people that want things compete to get them, and that bids up the price. If the price is going down, the opposite is occurring. Nobody wants things, and so the entire economy is effectively on discount to try to engender demand. We might get a picture of just how fleeting all of this looks when we consider the numbers due over the weekend, where we're going to get Chinese inflation figures, and in particular the consumer price index, which we can see here really speaks to just how anemic demand is, hugging the zero line. For wholesale prices, things are even worse. They've been in deflation mode since essentially the middle of 2022 and have recently taken a turn for the worst, implying that even in the pipeline, demand is not strengthening, but rather weakening. And so when we consider these numbers, they might very well be a helpful way to look at what comes next. The expectation, incidentally, is that we are going to get PPI slightly less negative, down 2.5% for October when these numbers come across the wires. And the headline inflation rate will continue, the consumer price index will continue to hold at 0.4%. So essentially zero, and maintain this deflationary story. Now, we just saw from the trade numbers that we continue to see since about the middle of the year deterioration in imports. That, of course, is that same demand story, or lack thereof, in the domestic market that then shows up in CPI that can't get very far away from zero for the better part of 2 years. And so as we look at this, the concern is that all of the optimism that we've now seen thanks to these export numbers in Chinese markets, in Chinese proxy assets, becomes something that unravels once this picture of domestic demand is in front of investors. Because indeed, if the upswell in external demand is temporary, then you need that domestic demand as the more lasting engine of expansion. And if that's not there, then it really is just a flash in the pan before the tariffs strike. As a matter of fact, if you look at the way that Chinese economic data has performed relative to expectations, this is data from Citigroup here, you find that it continues to trend toward underperformance, although it has narrowed a little bit back onto zero, suggesting that the expectations in the markets are getting to be about even with what reality is endorsing. Nevertheless, the bias still favoring softness. Moreover, we see that all of the expansive stimulus that China has unveiled is not working because most of it is monetary. And so we do not have the kind of demand that would be engendered by directly stimulating from the fiscal channel, from government spending, some sort of uptake in the economy. Instead, much of what Chinese authorities have done so far has been to lower borrowing costs by various ways, to try to encourage people to buy, to try to encourage businesses to invest, to try to encourage local governments to make outlays. And what we find is that this Bloomberg Credit Impulse Index, which is a measure of new loans as a share of GDP, it is actually falling and has been falling since the beginning of the year. So this is plainly not working. In fact, if we look at the year on year, which is the yellow bars here, the rate of year on year change in this index, it's actually accelerating over the past 3 periods deeper into negative territory. So not only is credit easing not working, the situation is actually accelerating in the wrong direction. Of course, the precipitous running away of foreign capital from China does not help matters. At this point, we're looking at nearly a 30% year-on-year decline in foreign direct investment. Money is plainly running out of the country. And so what we're looking at here then is the kind of setup that might allow for an attractive trading opportunity, betting against this recent optimism after the numbers that we saw this week. And while betting on Chinese equities themselves might be an unattractive idea because Beijing can effectively mandate those higher for no reason other than it say so, and copper might be a little bit of a challenging instrument because the futures contracts are a bit large and the ETF equivalents are not the most liquid things out there. The Australian dollar provides an attractive vehicle. We can see it too has surged over the past 24 hours and has in fact fared better against the dollar than, let's say, the euro or the pound in the wake of the election outcome. Both of those currencies suffered much deeper losses against the dollar. But now we're approaching some interesting resistance here near the 67 figure. If in the wake of the CPI data, we hit a wall right here and appear to be rounding out some kind of a near-term top, then an attractive selling opportunity back down into the sort of 66 area, plus or minus 20, 30 pips in each direction, this area right here, that starts to be an attractive target for a tactical short, if, of course, that topping here materializes. And that is macro money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go there from. I'm back with Chris for Futures Power Hour tomorrow, back with Victor and Tom for First Call on Sundays, again on Futures Power Hour Mondays, on the Price of Truth on Wednesdays, writing for the news and insights portion of tastylive.com, and commenting on the platform formerly known as Twitter at Ilya Spivak. If you're watching on YouTube, like and subscribe. Macro Money's back next week. Happy trading.
Tomas, we're back, my friend. You know what that means. Time for a little bit more Tasty Live. That's right. Coming at you with this market measure.
Looking at some of these stocks, the NASDAQ looks a little bit weak, but...
Not if you're looking at Tesla.
Or Coinbase.
Or Coinbase. You are correct. But you are right. The NASDAQ, Mr. Obvious, is down 52.
Yeah, I'm mad about my Tesla position. Not happy.
Yeah, get in line. Me too.
Yeah, I know. Baba getting whacked today.
Baba is getting whacked today. Baidu also. Baidu down 360.
I know. Baba getting whacked, and all the Chinese stocks. I haven't looked at. Let me just see. Where's my? Yeah, that's a pretty good. That's a pretty good
beatdown.
It's a pretty good beatdown. I rolled down some calls. Rolled down some calls in Baidu just for the hell of it. All right, let's do this. The bond move is saving our butts today. Bonds and notes. We've been talking about it nonstop all week as being the best play on the board, and it wasn't without a lot of pain, but it did turn out to be a good play. But it was with a lot of pain.
Yep, agreed.
And it probably saved us from getting short stocks, which would have been worse.
True that.
Yeah. Crude oil down $2. I don't know if you're watching it. Pretty big.
Yeah, big move in crude oil. I'm kicking myself. I don't have a crude oil position. I want to put something on with the IV rank so high, and I didn't do it.
There's plenty of liquidity in there. Mm-hmm. So you can pick your poison.
Yep.
I've been adjusting positions, and the U.S. dollar is also a little weaker today, which is good for us.
Yep.
Anyway, let's do this. This is a market measure, but right before we get into the market measure, just real quickly, this is my last time to mention next week because we're going to be on the road heading to Europe tomorrow for 5 shows. First one's in Edinburgh, which is going to be awesome. And these are small shows, so they're not going to be crowded. There's not going to be a ton of people. You can ask questions. You can see the screen. You can see what we're doing. We're just going to try to trade like a crazy person for about an hour. Hopefully the markets will be busy. I know Monday's a holiday, but I think the markets will still be pretty good. Volatility's high enough.
Futures markets are going to be tight.
Yeah.
I mean, you've got banks closed and you've got the electronic market open only in the bonds, right? I mean, the open outcry's closed in the bonds. Everything else is open. I think it's going to be another day as usual. Maybe a little lighter volume, but another day as usual.
I agree. Anyway, Edinburgh on Monday. If you haven't signed up yet, tastylive.com/events. Manchester Tuesday, Birmingham Wednesday, London on Thursday, which is sold out, and Dublin on Friday, which I believe is also full now. But again, they're all smaller shows. But Edinburgh, Manchester, Birmingham, London, Dublin, I can't wait. And we're going to have some fun over the next couple of days.
Beautiful.
We're taking off a bunch of bonds and no positions today, so we don't have to worry about traveling with a ridiculous position on.
You won't have to worry about the bat butchering your position.
I don't have to worry about the bat butchering my positions, yes.
You're so cute. You really are so cute sometimes.
08 now in the bonds. Need to sell some at 10.
Oh, how about 09, my friend? 09.
09s. I need to sell some at 10 and I'll be
God, you're making so much money there. You don't even care anymore. You're giving away ticks.
Be very happy.
And I'm the butcher.
All right. Let's hope this all works out. Let's do it. Anyway, tastylive.com/events. The bat will be here all week next week with Nikki and the rest of the team. So we'll have a full house in studio, and hopefully I can live stream some stuff back to you. We'll see how that goes.
Oh, that'd be awesome. Be fun to see you.
Hopefully. Yeah. Fingers crossed. We get some live streaming going. All right, let's do it. Market measure, please. So what comes after earnings? What comes after earnings? Let's take a look. Do stocks go the way of earnings, or do they go the other way?
I believe after earnings, I believe they trend sideways for the most part. I mean, I think depending on and again, I haven't seen this, the study set, I would say it was sideways to higher just because we're at all-time highs, Sadnov.
So the question is, if